the end of the day, the best fundamentals are still in U.S. large caps.
Everybody's on the same side of the boat, which makes the market vulnerable to volatility.
Everything seems to be going the way you want it to go. But I think there are significant amount of uncertainties.
You're going to get some good results, you're going to get some bad results, and that's going to kind of create volatility in the market.
Once we get a little dose of reality into 2025, I think that's when you want to start to take some risk off.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The last month of 2024. Where did all of that go? From New York City this morning, good morning for our audience worldwide. Bloomberg Surveillance starts right now with equity futures on the S&P 500 shaping up as follows. Just a little bit lower. We're down by about 0.2% as we come into Monday at all-time highs on the S&P 500. The best month of the year so far on the S&P, Bramo, going into payrolls on Friday.
And most of the time, December tends to be a good month because people are feeling good. They're going on vacation and it's coming off of Black Friday, which evidently was yet another success. Here's the real question. Do we get some kind of kink in the perfect picture here, given the fact that we do get payrolls, we do get sort of a check on the economy at a time where there still are people thinking maybe we could roll over?
The calendar stacks up as follows. You're all familiar with it. Payrolls on Friday, the estimate's something like 200K based on our survey. Then, Lisa, on to next week, CPI. The week after that, the Federal Reserve, December 18th. The take at the moment, the consensus seems to be that you need a beat on payrolls, an upside surprise on CPI, and the Federal Reserve will hit pause on the 18th.
Yeah, but it's pretty high bar. That seems to be the case. It seems like they're going to cut rates this month and then maybe pause next month. I do think it's interesting that Jerome Powell was not supposed to speak. And then he was slated in to speak this Wednesday at the Deal Book Conference. There are a whole host of different Fed speakers coming out this week. And normally, what else is new? That's what they do. There is this question, though, about whether there is a new message that they're trying to get through in terms of, A, their independence from any sort of political process, and B, the path ahead and what the logic will be behind it.
Tariffs. Can they model tariffs now when they get together on December 18th? I've got no idea, but the market believes that they are just a threat, a negotiation tool. Talking of consensus, this came from Pittachi of Academy. Now the consensus has become that everything President-elect Trump does is just a start to his bargaining. I'm a little concerned that the market has become a little too complacent. The standout quote for me over the weekend, this from Axios. Trump has been telling friends he denied Robert Lighthizer, his pro-tariff China hawk, U.S. trade representative in his first term, a cabinet role because he's too scared to go big. I think we've got to pause.
Yeah.
If you're worried that Bob Lighthizer, Ambassador Lighthizer, is too scared to go big, just how serious are you about tariffs over the next 4 years?
You know, this to me is the ultimate question heading into year end. Last week, we saw the 10-year Treasury yield down some 23 basis points, in part because of Scott Bessent and his belief that ultimately the market would be the check to President-elect Donald Trump, and that essentially we would end up with someone who would be reined in by the fear of a market getting ahead of himself. Now the question is that truly the case? We are just seeing the opening salvos of something that promises to be bigly, and we see that pretty much on a broad scale. So at a certain point, we don't know. This is the euphoria. Can it last another month? Maybe. He's not even in the White House yet, although he is in White House South.
He's in the winter White House.
Yes, correct. That's
in Mar-a-Lago, and he's already getting foreign dignitaries visiting him, including the Canadian Prime Minister.
Okay. What did you make of that?
Making promises.
Yeah, I mean, honestly, really, of course they're going to make promises. Although I love the sort of counter discussions from the Mexican president and Donald Trump and whether he actually did agree to anything. But all this just feels like it's kissing the ring ahead of what promises to be a moment of a lot of drama come next year, January 20th.
I enjoyed the group photo. Did you see the group photo?
Yes, I did.
With a child in the background making the moose face?
That's correct. It seems about how we often
enjoyed that as well over the weekend. From New York, welcome back. I hope you're having a wonderful Thanksgiving here stateside and a long weekend as well. Equity futures as we wake up Monday morning, just a little bit softer. We're down by almost 0.2%. In the bond market, Lisa was talking about yields. Yields are a little bit higher today, up by 4 basis points. The 10-year 421. 10. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth, expecting the rally to continue. Terry Haines of Pangaea Policy on Trump's warning to BRICS nations. And Tom Narayan of RBC as the CEO of Stellantis steps down. We begin this hour with stocks at record highs following the best month of 2024. Cameron Dawson of NewEdge Wealth writing, can't fight the moonlight through the end of the year. Seasonality remains strong and the trend remains robust, supporting markets continuing to press higher through December. Cameron joins us now for more. Cameron, good morning.
Good morning.
And a belated happy Thanksgiving. It's good to see you.
Happy Thanksgiving.
How much momentum do we have going into year end?
Well, certainly the chase is on, and we can see that in how markets are trading with this strong resilience, still a very powerful uptrend. Now, that doesn't necessarily mean that it can continue this robustly going into 2025, but we know this seasonality just continues to drag people into markets. We have positioning that's in the about 85th percentile using the Deutsche Bank consolidated positioning, suggesting there's still more room to draw people in. Then you start to have to contemplate when you hit January, February, stretch positioning, stretch sentiment, stretched valuations, stretched earnings expectations, but that's probably a 2025 problem.
Not too stretched, though, based on what you've said and what we've seen so far. In November, the scores up 5% on the S&P, Nasdaq 100, similar move. The Russell up double digits, up almost 11%. Can that move continue? Maybe not at that pace, but can the outperformance, relatively speaking, on the small caps continue?
It has to be supported by earnings. Nowhere in this market is there a higher bar for earnings in 25 than small caps. You have 50% growth based on current consensus. So right now, this is all about a positioning chase. People being underweight small caps, having to show by the end of the year that you're at least neutral. The question is, once you get to neutral, and you have seen those flows into small cap ETFs be aggressively strong, that does set you up with that high bar of earnings, and you really have to deliver. Also note, small caps aren't that cheap. You see them trading at about 27 times forward on the Russell 2, which we know is skewed by unprofitable companies. But I think the point is you have to see the earnings deliver. But for now, we're in that moment of the suspension of disbelief.
Suspension of disbelief, which could potentially go through December because of the holiday spirit and the fact that December tends to be a good month. Did we learn anything about consumers over the past 4 days other than the American is still the ultimate consumer?
Well, we see this consumer being extraordinarily strong. I braved the outlets in Orlando on Black Friday and saw lines out the door, 100 people deep, to get into luxury stores, which just suggested that the consumer still has this willingness to spend. Now, I think it's misleading to talk about the consumer in aggregate because we know that they are so bifurcated between the lower income and higher income consumers. But the higher income consumer simply punches above their weight. They make up double their weight in the overall path of consumption, which just is to say is that because that consumer still remains resilient, they're less sensitive to inflation, less sensitive to interest rates, they've been the one pulling this higher. The question is, can that momentum continue in 2025?
There's also this question about the Trump trade and whether it's the same this time around. John was asking about whether small caps can continue the outperformance. And I was looking at a study over the weekend showing that actually smaller businesses are more likely to be affected by tariffs negatively than some of the larger businesses because they don't have the heft to negotiate. So you have to wonder if the Trump trade is really going to have the same kind of contours as it did back in 2016, because we're at a very different starting point.
Unless we forget that yields are that much higher. And that is the key other part of the small cap trade, which is that there is an implicit expectation in small caps being strong of yields coming down because of refinancing, because of the degree of floating rate debt on those balance sheets. So if you are in a world where tariffs do keep inflation higher, at least for goods prices, then you are in a scenario where you have yields that remain higher for longer, the Fed maybe not cutting as much. And then you have to question that it's not just about the income statement for small caps, it's about the balance sheets and the issues you could have with balance sheets if interest rates do stay higher.
So this gets us to CPI and the payrolls report as well. Let's start with inflation. Do you see good reason to continue to bet on moderating inflation through 2025?
If we look at the big buckets, at least today, of wages that continue to look like they are moderating, look at leading indicators like JOLTS, look at housing prices. Those in the active, the current rent indices don't suggest a reacceleration there. Then the wild card is energy prices. And energy prices falling have been the key boon for consumers over the last 2 years. You're out of the point where they're falling down 20% on a year-over-year basis. They're about flat. The question is, do they move higher? And that would be the key question mark going into next year, is that can you continue to see energy prices be a tailwind?
The key question going into December 18th is whether the dots in the dot plot move higher as well. Yeah. How does the SEP change in 2 weeks' time?
Well, we think the dot plot's going to be relatively hawkish because you have about 100 basis points of cuts marked down for 25 in the September dot plot. So we think that they are going to cut in December unless we hear from Powell and he says something different, or we hear from the Wall Street Journal and they say something different. But we do think that that dot plot will show fewer cuts. We're thinking 2 cuts likely over the course of 2025. And then the S&P raises the question of what do they do with growth? Growth has remained more resilient. There could be upside to the GDP forecast, and then likely see some stickiness within inflation as well. Because if you look at the S&P, they have 2% kind of going out over the course of the next few years. We're seeing inflation remain stickier, which just suggests that that has upside as well.
So no one's listening. Why do you think Jay Powell is actually speaking on Wednesday? Because this is sort of new, right? It kind of came out of the blue. They agreed to speak at the Deal Book conference. So what's he going to say?
I have no clue.
Oh, come on. Just come on, extrapolate out. I mean, honestly, there's sort of this slew of different Fed speakers. And I'm just wondering, okay, what are they going to speak? What are they going to talk about? I mean, they've been talking all this time, right? Waller, Williams, Goolsbee, Kugler, Powell, Musalem, Christine Lagarde also kind of getting in the mix. And I'm looking at Bowman, Goolsbee, Hammock, and Daly. They're all lined up. So what are they going to say?
I think that they are going to acknowledge that this need and urge to get down to a phantom neutral rate, whatever that rate may be, has a lot less urgency given where economic growth is and given where inflation is. When Goolsbee was talking about hundreds of basis points of cuts to get to neutral, in the face of economic conditions, financial conditions that remain near 2021 easy levels, we've been raising the question of why the urgency, why need to cut so much? So we think it'll be acknowledgement of the resilience and growth, but here's the plot twist. Economic surprises are actually starting to turn lower. That's the reason why yields are falling, we think. It's less about the narratives about fiscal prudence, but that economic surprises are starting to bring those yields lower. So it could be that they're saying everything is resilient just at the point that we start to see a slowdown in growth.
So that's what I wanted to pick up on. Is the Fed still driving the bus? Or is it sort of the economics, or is it the politics, right? We're in this sort of headline whack-a-mole. And it seems like the market's like, we got this game. We're going to ignore the headlines because that's what seems to work this time. And so people aren't taking things too seriously when things come out, like 100% tariffs, and you're dead to me. But there's this question going forward about what the focus is going to be for markets. Is it going to be the Fed? Is it going to be economic surprises? Or is it going to be some of these political headlines?
Well, we think that economic surprises is what's going to be whipsawing the long end of the curve and the short end of the curve, if that matter. When we got up to about 4.4% on the 2-year, you were effectively pricing out any interest rate cuts over the course of the next 2 years after December, which said to us that this was a market that was not pricing in or contemplating any chance of recession. And that then makes fixed income a very interesting kind of hedge, because if you're not pricing in any chance of a slowdown in growth, it means that if you're trying to hedge against a slowdown in growth, that's a pretty good place to do it. So we would watch those economic surprises really closely. That likely matters more than these rather fleeting narratives about fiscal prudence and tariffs and all of these questions about what's going on in White House South.
Bond yield bouncing this morning at 4 basis points. White House South or Winter White House? What are we going with?
I don't know.
White House South?
I actually would like to see the equivalent of the Oval Office in
Mar-a-Lago.
Mar-a-Lago. And I was actually looking for someone to have done that research, but I couldn't find it. So if you have it, please send it.
Cameron, it's good to see you.
Good to see you.
Cameron Dawson there of NewEdge Wealth. If you are just joining us, welcome to the programme this Monday morning. Equity futures down by close to 0.2%. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Joe Biden has signed a sweeping pardon for his son, Hunter Biden, reversing his previous stance that he would not use his executive powers to aid his son. The president wrote in a statement, quote, "The charges in his case came only after several of my political opponents in Congress instigated them to attack me and oppose my election. No reasonable person who looks at the facts of Hunter's cases can reach any other conclusion than Hunter was singled out because he is my son, and that is wrong." Stellantis shares lower in the Italian trade, down by more than 8%. The company's CEO, Carlos Tavares, is quitting sooner than expected, with the automaker grappling with slumping profit and weaker U.S. sales. The maker of Jeep SUVs and Fiat cars will be run by an interim committee headed by Chairman John Elkann. A new CEO will be named in the first half of next year. Disney's Moana 2 broke the record for the highest grossing Thanksgiving weekend with $221 million in ticket sales in the U.S. and Canada. Frozen 2 had held that top spot since 2019. Wicked from Universal Pictures and Paramount Global's Gladiator 2 finished in second and third place, respectively. Those films brought in a combined haul of $168 million during their opening weekend, and that marks a strong start to the holiday movie-going season. That's your brief, John.
Danny, thank you. I'm responsible for About $25 of that grand total over the weekend. Gladiator 2.
Oh, I was about to say Moana 2. Didn't really take that for you.
Didn't get that far.
Okay.
Went to see Gladiator as a standalone movie. Okay, pretty decent. As a sequel to one of the best movies I think that's ever been made. Fell a little bit short.
Really? You were disappointed?
Storyline was decent, but some of the scenes, we can talk about this later.
I'm
not sure there were sharks in the Colosseum. Did they bring sharks at any point? Maybe I'm wrong.
Well, come on. It adds to the drama, the joy. I'm waiting for Oppenheimer too.
Are you? Mm-hmm. Is there a follow-up to that?
Absolutely not.
What's the follow? What would the follow-up be?
I don't know. I'm just saying
just mean
everything
they're
is
over the
two.
top on sequels.
Yeah,
okay.
Come on. That's my point. This is sort of the least likely because what else could you say?
Taking some time to get up to speed, Brown,
I know.
with your humour. I apologise. Up next on a programme, Trump's warning to BRICS nations.
If there are ways, let me put it this way, that EM can satisfy and actually make the Trump administration be less of a target for them, I think they will do it because that will actually minimize volatility, allow them to get back on a better route, at least going into the next 4 years.
That conversation up next, live from New York City this morning. Good morning. Equity futures right now, just a little bit softer. We're down 0.1%. In the bond market, yields a little bit higher at 4 basis points. 4.2129 on a 10-year. You'll notice the dollar strength. We can talk about that more broadly in just a moment. But the euro weakness, 105.23. Lisa, all eyes on France through the week in the European government bond market.
Yeah, Marine Le Pen essentially threatening to torpedo the government and have a no-confidence vote as soon as today because the budget is not amenable to certain aspects that she's proposed, including this idea of potentially extending and actually adjusting pensioners' salaries to inflation. It just raises this question between a rock and a hard place with a fiscal deficit of 6%, while also some of the demands coming from the political, the political momentum right now.
At a time when Europe has some big problems. Euro dollar right now, 105.22. Under surveillance this morning, Trump's warning to BRICS nations.
You need to have stable currency in order to basically have sustainable portfolio flows in the long run. So if there are ways, let me put it this way, that EM can satisfy and actually make the Trump administration be less of a target for them, I think they will do it because that will actually minimize volatility, allow them to get back on a better route, at least going into the next 4 years.
Here's the latest this morning. President-elect Donald Trump warning BRICS nations not to create a new currency to replace the US dollar, threatening 100% tariffs if they do. Terry Haines of Pangaea Policy writing, there are larger market opportunities now being triggered by Trump's bid to shed Washington's obsolete post-Cold War sludge to master the highest geopolitical risk in over 50 years. Terry joins us now for more. Terry, wonderful note over the weekend, sir, and thanks for giving us some time this morning. I want to talk about the way you think we should be viewing what's developing in Washington, D.C., to move away from the old way of looking at the nation's capital, and you introduce a new way of looking at things. Can you just explain that a little bit more, Terry?
Yeah, of course. I think markets make a mistake generally, and I think a lot of Washington people make a mistake to look at issues in a siloed sort of way, in a binary sort of way. Tariffs or no tariffs. Will Trump do this or that? What Trump is trying to do, I think, in this time out is very much different than the first time out. And to your point about BRICS, I think it all starts with geopolitics. You know, geopolitics is what's driving all of this stuff. And if you think about it, you've got the BRICS statement that just happened. You've got allies in Canada and Mexico already meeting with Trump about a lot of this stuff. And meanwhile, you've got two hot war zones, a third one in the South China Sea that may break out at any minute. You've got Chinese vessels captained by Russians in dragging cables in the Baltic, mysterious drone swarms, all kinds of things like this. But what I would urge people to understand in markets simply is that what Trump is trying to do is trying to transform Washington to deal with the highest geopolitical risk in 50 years, combined with this kind of long twilight struggle with the Chinese in what's termed competition. That's going to take, Trump guesses, that's going to take a massively different sort of Washington. That's what he's driving at.
So, Terry, why go after Canada We got that question in the last week. If you take a step back from things, what's the objective there?
I think the objective there simply is to say, look, we're interested in making sure our borders are as secure as possible, and we're going to talk with both of the nations with whom we have physical borders about these issues and deal with it. And I think it's not a lot more complicated than that.
Terry, what do you make of Donald Trump's comments around the BRICS and sort of the discussion around having a different alternative currency to the United States, given the fact that they met in Kazakhstan in Russia, where they couldn't use Visa or MasterCard? They needed to bring either dollars or euros in order to actually transact because none of those other methods of payment even worked. Why would he go after something that doesn't even seem like a realistic threat?
I think, frankly, what this is about is about Trump telling China, frankly. I think this is much more about China than it is about the BRICS. We are going to contest you everywhere. And, you know, the Trump people judged that was not happening in the current administration. But in the Trump administration, the message to China is, we will contest you everywhere. We will contest you on currency. We'll contest you on Belt and Road. We'll contest you, geopolitically everywhere that we need to do that. And we're not going to miss a trick. And we're going to try to maximize our ability to work hand in glove with our allies. And we are putting the unaligned world on notice as well, that they don't have to choose this minute, but there is a time for choosing at some point. I don't want to make this sound too dramatic, but and the Trump people, I think, aren't particularly subtle about this. But again, I think looking at this through a geopolitical lens provides a frame for which markets and investors can look at a lot of this stuff and gain some clarity about it.
There's this big question about whether markets will essentially provide a check on President-elect Donald Trump as he focuses on rearranging the geopolitical cards. And I just wonder how much that actually is true. In other words, is this a president who actually wants a strong dollar policy and will alter a path if he doesn't get it?
Well, I agree with those who say that the statements, if pursued to their logical ends, provide some contradictory signals. But again, I think that what they're trying to do is trying to reorder things in a way that markets will like. One of the signals that Besson sends that markets like, of course, is on tariffs. Another one is trying to control debt and deficit, and they're trying to make both of those things happen, and that's going to be very, very difficult. But I think, generally speaking, what needs to happen is kind of looking more broadly and then coming down to the more specific. But I don't think you're going to get clarity on dollar policy for a little while to come as you wrestle through both tariffs and the tax bill, for example, just to start.
Terry, just quickly in the 30 seconds we have left with you, do you believe these tariff threats are credible threats that the incoming president would be willing to follow through on?
Look, it's all, markets think it's all about one side or the other. My view is that investors shouldn't shouldn't kid themselves. This was never going to be about all one thing or all the other. I imagine you're going to see some tariffs in on day one. Think of them as performative, but think of them as real as well. But I think the bigger action doesn't come till later in the year when you marry this up with the tax bill overall. Trump is not going to want to tank the economy in the first year.
Hey, Terry, good to hear from you, sir. Terry Haines there of Pangaea Policy on a big 2025 just around the corner.
Yeah, and contradictory signals for the market with a whole host of different policies. His point there, Terry's point about the reordering of things, I wonder how much they're already on a path to be reordered. And I ask this especially with the current administration actually levying either further restrictions on Chinese chips. And we're going to talk about that in a bit. But again, how much of a change is this?
We'll talk more about that through the hour. Up next on the program, Tom Narayan of RBC as the Stellantis CEO announces he's stepping down from New York City. This is Bloomberg. Equity futures right now on the S&P 500 just a little bit softer. We're down here by 0.1%. Recovering though, and off session lows. We're positive on a Russell by a quarter, following a massive month of gains for the small caps through November. Lisa, through November, the small caps up by almost 11%.
And this actually is the idea that not only will tax cuts disproportionately benefit the Russell 2000, but that the Trump trade last time around was beneficial to the smaller companies. Key question now is, will this time be different just simply because tariffs might affect them differently? And frankly, yields. Can't forget yields. At what point do the higher yields really cap the potential gains in some of these companies?
Let's get to those bond yields right now, and we can look at them stateside first and then get to Europe, which is where the fireworks have been over the last few weeks. 2-year, 10-year, 30-year, yields bleeding just a little bit higher, up by 4 basis points on a 10-year, 421.29 going into payrolls Friday. The estimate for Friday in our survey so far, the median is about 200k. If you want some fireworks, look to Europe. The euro's weaker against the US dollar. Euro dollar right now at 105.26. Yields in France just about unchanged, anything but unchanged over the last month or so, pushing 3% on a French 10-year, with that government looking fragile.
To me, what's fascinating is that the bond vigilantes are out in full force when it comes to places, even in Europe, in some of the biggest economies, even though they are absolutely somnolent over here in the United States. If there is a threat of a 6% debt to GDP situation in France and an opposition government that wants to pull all the levers and end up with different breaks. Basically, the bill that they had would have provided certain cuts that were not amenable to Marine Le Pen. So now you end up with a higher deficit and a bond market that's looking to call foul on this. How much does that actually work?
Euro dollar 105.26. Under surveillance this morning, President Biden signing a pardon for his son Hunter. The president justified the move by saying that the case against Hunter was politically tinged and excessive. It's a reversal from his previous stance that he would not use executive powers to aid his oldest living child. Hypocrisy is a word we've all heard repeatedly. I think The Guardian went with heartfelt hypocrisy, which is a rather kind way to put it. What developed just yesterday evening?
This is my shocked face. I don't think that anyone's particularly shocked. People will feign horror at the hypocrisy, and it certainly is hypocritical. And anyone who believes that he was singled out by a Justice Department under Joe Biden to really go after some of the allegations, I don't think there's a lot of momentum on that argument. I will say that last night my kids said, "Would you pardon us if you became president?" And I said, "Please eat your broccoli first, and then we can have that discussion." And then now the real question is, when's he going to pardon Commander?
Commander the dog?
Yes.
What, is that actually a real question, or are you just making light of the situation?
Well, I don't know what else to say.
Okay.
I mean, am I going to feign horror and outrage? Because at a certain point, nobody is particularly surprised. Is it hypocritical? 100%. You've got to question over the legitimacy of some of these allegations and the role of the pardons, and you can have that larger discussion, but I think everyone's just kind of like over it.
I'm not sure what charges Commander is up against, but we'll move on. France's far-right party indicating that it could topple the government as soon as this week. Marine Le Pen and her party threatening to support a no-confidence motion unless Prime Minister Michel Barnier tweaks his 2025 budget. All of this going into a really important ECB meeting over the next week or so. European Central Bank with a choice of 25 versus 50. The politics screaming 50. The data, some might argue, away from inflation, the output data, the latest PMIs in the continent, also screaming 52.
And the irony is that the people who are against it are the Germans, and they actually are the epicenter of the pain, the recession, the auto manufacturing pullback that we continue to see. So there's a real question. Do you get a change in tone from the beacon of austerity in Europe at a time where it seems like anything but is really required? And meanwhile, you have a real change in political leadership. France almost feels like it's experiencing some sort of, I don't want to say a similar or a parallel path as the United States, but it certainly rhymes in terms of the political heft. And you just wonder what kind of market pushback is different than the one that we get in the United States.
Michael Kushma, Morgan Stanley, will be joining us on that story in the next hour or so. Let's finish on this. Tesla and BYD ramping up incentives in China to meet annual sales targets. Tesla offering 5-year 0% loans and a 10,000 yuan discount on its Model Y vehicle until the end of December. BYD offering between 1,000 to 3,000 off some models. We've said repeatedly on this programme, one of, if not the, most competitive markets on the planet, the Chinese auto market.
And is it because you have an overproduction? Is it because you have a lack of demand because the consumer hasn't been spending? Or is it because simply this is the area, the epicenter of the electric vehicle boom, considering how the resources seem to be in the region? Unclear. But all I know is the race to the bottom seems very real, and it raises the question of actually imported deflation into certain regions that open their doors to Chinese vehicles.
There's a list of companies really struggling in that particular market right now. Stellantis is the one that's having a big struggle worldwide. Shares are falling to their lowest level since July 2022. On news of the CEO, Carlos Tavares is stepping down just 2 months after the CFO's departure. Bloomberg's Ollie Crook joins us now for the latest. Ollie, you've been following this auto market for quite a while. We've been waiting for something like this to happen with Stellantis. We thought that he would fulfill his mandate and be with us at least through 2025. What happened over the weekend?
Yeah, that's right, John. I think what's really sort of interesting is how quickly we went from unanimous support to basically strategic differences, and those strategic differences came to a head on Sunday, and now Carlos Tavares is no more as the head of Stellantis. We've had a sense, John, since the sort of profit warning back in September, I think you guys spoke to him actually just days after that huge shakeup, that the sort of automaker has been staggering forward since that profit warning, right? And days after that profit warning, he got rid of the CFO, he got rid of the COO, he replaced the brand heads for Maserati and Alfa Romeo. All of this, though, potentially not enough. I think that where you sort of get some of the bearishness in the market today is because you get this sense that there is some chaos and this sort of management shift, that this is not really a sort of managed change at the top of Stellantis, when really we had been expecting him to leave at the beginning of 2026. That obviously came a lot faster. And what the next CEO is going to have to inherit, while the sort of German automakers, as you guys have been discussing, have a China problem, Stellantis doesn't really have much of an imprint over in China. What Stellantis has is a U.S. problem. And sort of one of the great criticisms of Tavares, and potentially why the market liked him, is he was very disciplined on cost cuts. Those who are critical of saying that he cut way too much, and that has actually affected the quality of some of these brands, whether it be Jeep, whether it be Ram. They had about 12% market share in the United States at the beginning of last year. That has come down to 8%, and that is what the next CEO is going to have to deal with.
And dealers have been complaining about the lack of models now for quite a while. Ollie, appreciate your time, sir. Ollie Crook there of Bloomberg. Ollie mentioned some of the brands here stateside. Jeep, Ram, Dodge is another one. Look at the brands elsewhere. Fiat, Maserati, Peugeot, Citroën, Vauxhall, Lancia, Opel. The list goes on and on. Tom Narayan of RBC joins us now for more. Tom, good morning. Got to start there, haven't you? What do you do with that brand lineup?
Yeah, I think for the longest time, investors as well as shareholders and the management team have been wanting to rationalize this brand setup after the big merger with Peugeot, with FCA. It's just really difficult to do that politically. We think maybe that could be part of the decision of what happened yesterday. It's very difficult for the Agnelli family to go forward with that type of path. That might be what happened.
Do you get the sense that maybe the Agnellis are married to particular brands that they don't want spun off then? And which brands do you think they might be?
Yeah, I think that's probably right. It's probably more on the European side. That's the one that there's the most political opposition to that happening. Italy, obviously France, the UK, there's some opposition there. But in the US, that's potentially an area where we've heard that could happen. That could be where cuts could happen.
So essentially Dodge might go away.
Yeah, that's the one that folks have been looking at, Dodge, potentially some Chrysler. Yeah, definitely that could be where they target.
You raised another point, and this to me has a broader implication for the auto industry. You raised the question that what if the current administration, the current chair of the board, wants to expedite the wind down of a whole bunch of inventories, which has been one of the biggest issues, certainly in North America, and the drags on profitability, and creates a fire sale for some of the brands that are less loved. That would pressure prices lower across the board. How realistic is that?
I think the first place that they'll target is production cuts. That they've done a good job, actually. They cut about 100,000 units of production in the third quarter. And they've actually reduced the days inventory from like 109 days to 84 days. So there's nothing better than an artificial cause of supply shortages. Just cut your own production. That's probably where they'll start going. And the Agnelli family is very smart. They realize if you cut pricing, if you create a pricing war, that's a bell that you can't unring, you know? So I think they'll start with cutting production. But, you know, if you look at where Jeeps are priced at, if you look at where Rams are priced at, relative to the D3 competition, it's probably unlikely that they can get away without some price cutting. That probably will happen.
One big question throughout this entire earnings cycle has been how much is idiosyncratic and how much is it a broader industry issue? With the auto manufacturers, it's even more so. It's the likes of Stellantis, which has a lot of European brands, but it's seen the pain point actually in the United States. How much is this execution and how much is this the larger industry trends that have been affecting many other brands as well?
I think it's a combination of both. I mean, Stellantis was definitely notorious for trying to reinvent their brands. And give Tavares some credit. He thought he could reinvent Ram and Jeep as more of a premium brand, right? They're very different than when we were kids. And so that's been a good strategy. The problem is, what you guys pointed out, is how much has been really invested in these brands, the products themselves. If you look at Jeep and Ram, compare them to their direct competition, the D3, over the past, since pre-pandemic, that price inflation has far exceeded that of Ford and GM. So some people hope, at least for the sake of Ford and GM, that this is just coming back down to earth. Maybe it doesn't trickle and impact GM and Ford as much, but I have to believe, especially for Ford, which is more of a direct head-on competitor, think Bronco versus Jeep, et cetera, they're likely to see some pain next year.
This is a terrible time to sell assets. I think we both know that, particularly in the United States and elsewhere as well. They're not the only company having problems. We've heard the dealerships complaining about not having enough brands to sell, enough models of those brands to sell for quite a while. Nissan doesn't have the hybrid offering. I hear that a million times about the United States. There's a real worry about the future of that company at the moment. Who's got it right for you? Who's right there, executing in the moment where we need them to, at the right time?
I think you want to have U.S. exposure. I think you want to be in the sweet spot. GM actually has a pretty good lineup. They dominate that heavy, large SUV category, right? And also, they were rational when it came to pricing. They didn't go nuts, juicing up the pricing of their vehicles over the past 3 or 4 years. So they're well positioned. The other one, I got to say, is Tesla. They're well positioned on the EV front. They have the best cost structure there. We'll see what happens with the IRA, but maybe California bails them out. Maybe they don't qualify there. But I do think that they do have the best cost structure when it comes to EVs. Next year, you're going to have some affordable vehicles. Pricing is the main pain point. They have like half the market of EVs. And if we do lose the IRA credit in the U.S., maybe that disadvantages other EV makers and benefits them. So it's really, I think, GM and Tesla that actually benefit.
Have they been through winter yet? Have we had the storm? Have we been through the recession? I've been sitting here waiting for the cuts to capacity. I mean, deep, deep cuts to capacity across some of the major European players now for the last 12 months. Have we seen much of that?
I think it could get worse next year, right? You just started seeing, remember those profit warnings from those 4 European OEMs?
Yeah. Those
were massive, like 10% margins dropping to 5%. If that same thing happens, you're at negative. Right, you're losing money on cars for a legacy OEM. So that could be where we go in 2025. And if you were a new CEO at Stellantis, what are you thinking? You're like, maybe I just go all out, kitchen sink, right? Reset the bar, and maybe I lose money, for the first time in a long while.
I think that's the moment we're waiting for, that kitchen sink moment and what that looks like on that morning where you see some really big cuts. And I think we're looking to Europe for that.
Yeah, and until you get that, can you get any kind of revival, and can you even invest in a space that not only is dealing with an overhang of capacity, but also is facing the price wars that we were just talking about over in China, also knocking on the door?
Tom, it's good to see you. Good to catch up. Thank you, sir. Tom Narayan there of RBC on the auto market beyond just Stellantis. With an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Joe Biden arrived in Cape Verde early this morning as part of the first leg of his visit to Africa. It's his only trip to Africa as president and the first for a sitting U.S. president since 2015. He's scheduled to have a closed meeting with the Cape Verde Prime Minister, who greeted him at the airport before carrying on to Angola later today. President-elect Donald Trump plans to nominate deep state conspiracy theorist Kash Patel as FBI director. Patel is a critic of the Bureau and has threatened to fire its top echelons and shut down the agency's headquarters. His nomination is facing blowback from both sides of the aisle. His appointment is also dependent on the incumbent FBI chief, Christopher Wray, who Trump himself placed in the job in 2017, either being fired or resigning. Elon Musk asked a federal court to block OpenAI from becoming a fully for-profit business, saying the pause is needed to protect his own AI startup and the public. This is not Musk's first legal dispute with the Sam Altman-led company. Musk sued OpenAI in California state court in February, dropped the case in June, and filed a complaint in federal court in August. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, a record-breaking Black Friday.
It's really a shift in the retail landscape altogether. The internet has absolutely changed it. The social media players are also impacting how people discover goods, where they actually shop for goods.
That story up next, live from New York. You're watching Bloomberg Surveillance. Coming into Monday at record highs on the S&P 500, pulling back just a touch. We're down 0.1%. Under surveillance this morning, a record-breaking Black Friday.
It's really a shift in the retail landscape altogether. It's widespread. It's because consumers just haven't been shopping as much, particularly in the B and C tier malls. The internet has absolutely changed it. The social media players are also impacting how people discover goods, where they actually shop for goods. And what we're seeing even within e-commerce is a lot of fragmentation, particularly with smaller, lesser known players.
So here's the latest this morning. Black Friday e-commerce sales hitting a record high. Research from Adobe Analytics showing consumers spent $10.8 billion as data from Sensormatic shows in-store traffic falling year over year as consumers pick and choose to find the best possible deals. Joining us now to discuss, Poonam Goel of Bloomberg Intelligence. Poonam, who's getting this right at the moment? Who's winning?
The digital retailers are winning clearly. People are shopping more online. They're favoring convenience. They're favoring value. They're just wanting to sit home and surf the web to find what they need. And the deals are the same, so they can do it.
The dollar players have really suffered, Poonam. We've seen that coming out of the election. They've suffered because they're worried about tariffs. Once you get past all of this shopping over the next several weeks, they've got to confront January 15th, what happens with tariffs and what happens also with that agreement with the ports. So tariffs January 20th, ports January 15th, two very key dates for these retailers, Poonam. How are they managing inventory going into that next month when that big tariff hurdle might actually hit them after January 20th?
So some retailers have started planning by ordering more inventory ahead of it. That's a tricky situation because we don't know what the magnitude of the increase, if any, what it could be. And we don't want to get into an inventory hiccup where you have too much and you're having to mark things down. So I think it'll be challenging regardless of what happens. It really depends on the magnitude of the increase. Will it be up to 60% in China, or will it be another 10%? I think that really will dictate the magnitude of the impact to both the retailers and the consumers.
Poonam, are you seeing an increasing divide based on size of retailers in terms of the heft of negotiating some sort of efficiencies of scale when it comes to the likes of tariffs, as well as an online presence that seems to be really attracting the gravitational force?
Absolutely. Look, if you have scale, if you're an Amazon, if you're a Walmart, you clearly have that to your advantage, right? Because your volumes matter to where they're being produced and you can negotiate better prices. That said, if we see tariffs go up to as high as they were proposed during the campaign, 60%, which we don't, no one can escape that.
Okay, but putting tariffs aside for a second, there's a question just generally about how much you have seen the entire retail industry really transform over the past 5 years. You've seen an increasing share taken by e-commerce. There's a different type of in-store experience. I'm just wondering about what this looks like going forward at a time where it's getting more expensive for smaller players to keep up with the larger ones, with returns, with free shipping, with all of the other perks that Amazon and Walmart have made us all spoiled by.
Sure. So we estimate right now the retail sales online are 25% of total retail. It's going up to 33% in the next 6-7 years. So still clearly greater share in the online vertical. In terms of smaller retailers, you know, it's actually easier for them to be online today. With platforms like Shopify, they have the ability with no barriers of entry to sell stuff online. Yes, returns are a growing issue, but that's a small piece of the puzzle that exists for not just the small retailers, but also the big retailers. But overall, I think it's very easy to sell online today than it was a decade ago.
Poonam, Lisa's been talking about this for weeks, months, if not all year. Where does this leave Amazon? As Walmart really starts to execute, how much does this squeeze the likes of Amazon, which for a while in this country was just the sole winner online?
I think Amazon still stands out. It's clearly the lion's share of online sales. When you think about Walmart's share and Amazon's share, you're talking about one company that's at $100 billion in GMV online, which is Walmart. And then you're talking about Amazon, which controls about $700 billion in global GMV. So they're still very, very different. And Amazon leads in the discretionary aisle versus Walmart leads in the staples consumables aisle.
Do you see that mix changing at any point in the future?
I think it could, but it'll take time. It's not going to happen within the next 12 months in a drastic way. But yes, over 5 to 10 years, sure. But then there'll be two really different companies too, right? With Amazon really gaining steam in advertising, in media, and in its cloud business. So it's a different entity altogether when you look at them side by side. But on the retail front, you're absolutely right. The lines are blurring, and Amazon does have growing competition, but it's not just Walmart. It's also Temu. It's also Shein, right? These low discount players that have really climbed up the ladder very quickly.
So what are you watching, Poonam, heading into next year? Yes, tariffs are going to be a big issue, but you are seeing this ongoing transformation. We've seen this with Target with respect to what value means at a time where it's not just price, and the behemoths kind of going to war with one another.
I think the value focus will exist in 2025 like it has never before. People are focused on value. We saw it on Black Friday as well. And I do think that the larger players have an advantage because they have scale, so they're able to push the pedal on price further and more quickly. So value stays. I think experiences and preferences for what you want, where it is, also matters. So if you have the right product, if you have the right innovation, you're going to drive the customer interest. And everything else in between will suffer, as it has been for the last 5 years.
Poonam, can we just put to rest this idea that people actually enjoy waking up at 6 a.m. and fighting crowds and the day after Thanksgiving to go shopping? Is that basically what we're learning with the actual foot traffic going down pretty significantly?
I think so. I think the lines are blurring because people are finding the same deals online. Unless you're going in for that free $10 gift card at 6 a.m. when the store opens, there's really no reason to be at the store at 6 a.m. anymore.
Agreed. We're finished with it. Poonam, thank you. Poonam Kaur of Bloomberg Intelligence. Poonam, thank you. And a happy Thanksgiving, a belated happy Thanksgiving. There just isn't that product anymore. Is there that product that you'd wake up that early for anymore? There's no lines queuing outside of an Apple store for a new iPhone. Those days are gone.
Yeah.
They're very, very short. Haven't we moved on from all this?
Well, yeah, because Black Friday starts, the Monday before, and then it goes until the Monday after. So essentially, why wait in line? But also, aren't we glad about this? Isn't this sort of an evolutionary advantage not to have people that are trampling each other? And yes, we're showing a picture of a line as we're talking about how people don't do that anymore. But either way,
I do think that? The Macy's.
It's Macy's.
But look at it. They're putting away the railings because they don't need them.
Thank
there you go.
There
you go. The picture speaks to the story. Don't worry, Brown.
Thanks, I'm crushing it. But there's this real question here about, people don't actually enjoy being penned up like animals and running in and trampling over each other. Maybe it's just a very humane thing, stretching it out.
I think some people do enjoy this.
You think so?
Oh, yeah. I think they get off on the thrill of it.
Well, only if you have the deals.
Fighting for that large TV and that 25% off.
I don't think it would be the TV anymore. I think now it would be, PlayStation or... I'm trying to think what it would actually... Or an iPhone. Like the upper...
There's nothing exciting
iPhone
anymore to line up for. That's how I feel about it. There was always that toy when we were kids,
This could be an age thing. I mean,
there's not like... Maybe it's nothing we're excited for.
Okay. There isn't that toy, that Cabbage Patch Kid that I once really longed for.
Do you remember that Arnold Schwarzenegger movie?
Yes,
Fighting for that toy.
Yeah, I do. But is that you're sort of reminiscing over that?
No, I'm just probably going to watch that this weekend. Put that on the list of Christmas movies to catch up on. OK, let's move on. Up next on the programme, we'll catch up with Seema Shah of Principal Asset Management. We'll speak to Ed Mills of Raymond James, Wendy Stewart of Bank of America, Michael Kushma of Morgan Stanley. Equities pulling back from all-time highs, just a touch. We're down about 0.1%.
Later in an economic cycle, inflation is still a risk.
One thing we know about, cycles over time is that the big winners of the last 10 or 20 years are not the big winners of the next.
Most people expect some moderation in US growth next year, but not radically.
The problem is we're on a knife's edge when it comes to wage growth versus inflation.
The next 6 to 12 months is going to be really critical. This economy is still wobbly.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures slightly softer. We're down 0.1% on the S&P. Similar move on the Nasdaq, down by about 0.1. Contrast that. Compare it with November up 5% on the S&P, up 5% on the Nasdaq 100, on a Russell up by double digits, climbing by almost 11%. The next stop for this market, payrolls on Friday. The estimate in our survey so far, around 200K. Just how high is the bar for this Federal Reserve to hit pause?
And right now it seems like the bar is getting higher. We will find out because we will be hearing from a host of Fed speakers this week, including Fed Chair Jay Powell, who's going to make a surprise appearance in a moderating conversation at a conference on Wednesday. A key question here will be how much are they going to signal that they are going to cut rates, but that is going to be the last time? Are they going to set the groundwork for cut now, pause later?
So the conversation has evolved, and clearly the data has come in stronger than they thought a couple of months ago. In August, in that Jackson Hole speech, you felt like they were setting you up for the beginning of a deep rate-cutting cycle to protect the labour market, get back to neutral, and get back to neutral quickly. That story's changed. That story's changed because of the incoming data. How much does this story need to change because of the policy changes we're now anticipating for 2025? And can he really confront that story in a big way in the coming weeks?
A lot of people are arguing, postulating that they're not going to probably address it at the meeting in a couple of weeks' time. That said, that early next year, you're going to have to start considering it. Right now, we're just getting sort of proclamations and truths from the White House South. But there is this question going forward about how that really does increase not just potential inflationary pressures, but also what we're hearing from a lot of CEOs, executives who are saying, well, maybe we're going to have to raise prices here, or maybe we're not going to be as aggressive here. So, measuring sentiment might be as important as measuring what policies actually get into effect.
Have you noticed that nobody on Wall Street wants to be bearish going into 2025? See this across the board, note after note. Looking ahead to next year, Evercore's Junior and Emmanuel valuations alone do not end bull markets. Signs of a top haven't appeared. Jonathan Krinsky over at BTIG, the path of least resistance remains higher. Even though lots of different things look extended, Cameron Dawson, NewEdge with us about an hour ago, expecting this trend to continue.
Yeah, unless their earnings don't deliver. The earnings so far have been delivering, and we're at the end of the earnings season, so we're between that. And Decembers tend to be a good time. How many people want to bet against a president-elect who essentially is looking to markets to ratify his upcoming presidency and to ratify some of his plans? And that is the reason why people have taken a signal from Scott Bessent, maybe too much so, and that is an argument out there, that essentially the market will act as a check on Donald Trump. Of course, as we did hear from Cameron Dawson, there's a question about whether we're creating a narrative. I know, everyone's shocked. Creating a narrative around something that isn't actually moving markets. And it is fundamental data that is actually driving things.
You said this last week, and I think this is really important. You brought up a note from George Saravelos over at Deutsche Bank. The market's not responding to these tariff threats. And so long as the market doesn't respond, it just leaves the door open to make even bigger threats further down the road, and even bigger threats after that.
Yeah, we're less than 4 weeks away from the election. And you have to imagine that George Saravelos is onto something maybe early next year. And that's what everyone was saying, is that maybe this is a story for 2025, less so now, when it's more a matter of signaling of priorities and signaling of threats rather than actually being in the office and wielding the ability to latch tariffs onto certain industries. And that, I think, is a reason why people aren't taking it seriously now. Why worry now when you could just play and get returns?
And keep buying stocks, apparently. Stocks, by the way, just a little bit lower this morning, down by about 0.1% on the S&P 500, following the biggest month of gains on the S&P of the year so far. Coming up this hour, we'll catch up with Seema Shah of Principal Asset Management with stocks at record highs, Ed Mills of Raymond James as Canada and Mexico respond to Trump's tariff threats, and Wendy Stewart of Bank of America on the outlook for commercial banking. We begin this hour with stocks at all-time highs, investors looking ahead to payrolls, to CPI, and the last Fed decision of the year. Seema Shah of Principal Asset Management saying come early 2025, rather than reducing policy rates at each meeting, the Fed is likely to slow its cutting pace to every other meeting, with some risk that rates don't fall as far as either the Fed or the market had originally envisioned. Seema joins us now for more. Seema, welcome back, and it's good to see you as always. How problematic do you expect that to be to equities?
Well, actually, I don't know if it's going to be that problematic for equities. I think the key thing that equities need is the strong growth and almost a Fed put. So where it becomes really challenging, though, is if inflation starts to become a little bit more concerning, and then the Fed doesn't cut rates as far because they're worried about inflation expectations increasing. That, I think, would be the fly in the ointment for equities. But otherwise, I'm going to add to the masses. I'm pretty positive about next year.
Really positive about next year for the US and Europe, or just the US? Because all I've heard is the US, and Europe's kind of been left in the dust.
Yeah, I think the story for Europe has got even worse in the last couple of weeks. US exceptionalism was the story for this year. It's going to be the story for next year, even more so now that we've got the election behind us. And Europe, it was already struggling with weak fundamentals. The economy was already struggling. We've already seen evidence that now services is joined manufacturing in that cooling period. So I think it's a challenging period for Europe, and certainly for us, it's more about US equities in Europe. I think there are opportunities in other parts of the world, some segments in Asia, various pockets. But overall, I think this is going to be another year where you see continued strength for the US.
Seema, can you quantify how much you're sort of doubling down on this bet that the United States is going to be the bright spot and that Europe is going to be even worse than it was this year?
I think for Europe, I think the thing that we're trying to watch as well is we have to keep an eye on those technicals. Where is sentiment? We do think that sentiment is getting incredibly negative about Europe. As you just said, everyone is joining in to that massive US over Europe and becoming very, very negative on that side. Valuations are looking fairly attractive for Europe. So it could be that you just need a slight improvement in the outlook for Europe, some kind of upside surprises with regards to the economy, maybe the ECB really stepping in and starting to improve investor expectations. And that could be enough to shift that needle. But certainly at this stage, it's quite difficult to see that coming through.
There's a question, Seema, about whether you can bet at least on European bonds at the same time that you bet on American exceptionalism, because you can imagine the ECB is going to have to cut rates more aggressively. And if there is some sort of downturn, that could be some sort of haven trade. Do you believe that that is the correct way to go? Or do you think that that is premature at a time where the bond vigilantes seem to be having their pens and papers out for the likes of France?
Well, I think as it is always the case with Europe, you can't just look at Europe as one entity. There's so many different entities which are very different, disparate that in that region. Overall, yes, the ECB is going to be cutting rates far more aggressively than the US. I think there could be a 50 basis point cut thrown in there at some point in 2025. And they're going to be reducing rates below neutral, whereas the Fed is going to get maybe a little bit close to neutral, but probably not below. So there is reason to have that overweight to European sovereigns rather than the US. But as you said, you have to be really careful, and keeping an eye on what is going on with the budget deficits in every country that we're looking at, I think is going to be a key theme for next year. Because, we talk about Fed policy uncertainty all the time, but there's so much on the government policy side with, as you said, bond vigilantes really starting to gear up and keep an eye on what's going on in different countries. We've already seen it in the UK. We've seen some idea of it within the US, and clearly is coming through in France as well. So I think that is going to be a key conversation for all the countries for next year.
Which raises a question, Seema, about whether the correct trade on American exceptionalism is with the small caps, given the fact that they seem most leveraged to the potential of bond vigilantes just peeking out the window in the United States. Even that alone would be enough to potentially dent some of the valuations.
Well, look, I think for small cap, the run it's had so far is really about valuations. It's still due for that catch-up try. So it's catching up with the large cap and it's got attractive valuations. But as you were saying before, small caps, small businesses, they have a really significant exposure to floating rate debt. So if you're not going to see very significant rate cuts coming through next year, maybe because of increased inflation concerns, then that's going to be a fly in the ointment for small caps. So I think that you can run through for a little bit longer for small caps, but once valuations start to look a little bit less attractive, and certainly from a relative standpoint where large cap does continue to look more attractive, then I think the small cap agenda starts to really become a little bit more unattractive.
New question for the office quiz over the Christmas holiday period. Do you want the new question?
Yeah, please.
What's the DAX done in 2024? I'm not going to put you on the spot and make you answer that. Seema Shah, the DAX so far this year is up by more than 18%. And as we speak about how bad Europe is, the DAX is at all-time highs. Seema, it begs the question, what is the DAX doing at record highs if things are so bad in Europe and things aren't great in China either?
It's a great question. And I think this is a key thing for investors to remember, is that, look, from a relative standpoint, yes, it's going to be big differences and these are going to look more attractive. But if the US market is doing well, it does tend to carry most markets with it. So there will be opportunities globally. And I think when we're going into 2025 with so much uncertainty from a policy perspective, especially now with the new Trump administration coming in, it does make sense to have that global diversification. Our preference is still for Europe, but we do think that there's opportunities outside of US as well. So you do get to have some diversification, some exposure to different markets too.
It's the banks, Bramo. Commerce Bank, Deutsche Bank, year to date performed really well.
Yeah, and how much is this a catch-up trade? How much is this because there is this bet on rate cuts? And how much is it because the likes of Deutsche Bank have expanded dramatically outside of Europe? So it sort of goes to Seema's point that if they have some sort of footprint outside of Europe, they can benefit even if they're listed on the DAX.
Seema, it's good to hear from you. Seema Shah there of Principal Asset Management on the path forward into 2025. The takeaway from Seema is just how little needs to go right to really trigger some of these squeezes in some of these European assets.
Yeah, although it's a pretty high bar for a little to go right, considering that we've continued to be disappointed. I was looking, you talk about the DAX, take a look at the CAC over in Paris. And
down about 5%.
Yeah, it's underperformed the broader European stock market by the most going back to 2010. So talk about the splintering of some of the traditional behemoths in terms of economic heft of the European region. It becomes a little bit dicey to understand what the correlations are based on history because they're kind of breaking down.
France has been really weak. As we speak, equity futures recovering just about unchanged on the S&P. With an update on stories elsewhere this morning, here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Syrian rebel fighters are advancing southward after capturing much of Aleppo. It's the most serious challenge to President Bashar al-Assad in years amid the country's civil war, which began after an uprising in 2011. The rapid assault is being led by an Islamist rebel group based in northwestern Syria's Idlib province. Government forces, which are supported by Russia and Iran, have appeared to withdraw from some areas. Tesla and BYD are offering discounts and incentives in China to meet annual sales targets. That includes a 0% loan and cash discounts on certain models. On a post to its Weibo account, Tesla said that it's offering 5-year 0% loans and a 10,000 yuan discount on its Model Y SUV until the end of the month. BYD is on track to exceed its annual sales goal of 4 million cars, but its smaller rivals have already met their targets. And a major snowstorm blanketed parts of New York, Pennsylvania, and Michigan over the holiday weekend. Forecasters expected very cold temperatures and heavy snow to persist throughout the beginning of this week. The storm led to an emergency declaration in parts of New York and a disaster declaration in Pennsylvania, and officials warning of dangerous conditions for Thanksgiving travelers returning home. That's your brief. John.
Danny, thank you. So our holiday quiz is coming together. Name 5 companies on the Russell. Question 1.
Okay.
What's the DAX done year to date? Question 2. I think we need about 8 more questions.
Okay.
10 questions to make this work, right?
Yeah, I'm trying to think what they could potentially be. Which New York State county got the most snow over the past 4 days?
You know the answer to that, don't you?
Barnes County.
Okay. How deep?
It was 45 inches of snow so far.
Wow.
Yeah, if you take a look at some of the totals, it's like 4 feet that are expected in Watertown, I think, New York. But I don't think that's going to make it on the quiz. Don't worry. Stop doing research on that one.
That's incredible. Futures right now on the S&P just about recovering, almost unchanged. Up next on the program, Canada and Mexico preparing for President Trump.
I believe that he's stepping up and making this statement about tariffs to tell both Canada and Mexico we have got to get our border security in the United States squared away.
That conversation up next. The path to year end looks like this. Friday, payrolls. Next week on the 11th, CPI. December 18th, the Federal Reserve, then go home. Year over. At least we hope. Equity futures on the S&P right now, down by almost 0.1%. Check out the bond market. Yield starting the week just a little bit higher, up 4 basis points. The 10-year, 420.91. Under surveillance this morning, Canada and Mexico preparing for President Trump.
I believe that he's stepping up and making this statement about tariffs to tell both Canada and Mexico we have got to get our border security in the United States squared away. And then secondarily, I think he's very concerned about imports from other countries that are going to try to take advantage of the USMCA. He's also using it as a lever to get serious conversations in Ottawa and Mexico City with Washington.
So here's the latest on that front. Fresh off a visit to Mar-a-Lago, Canadian Prime Minister Justin Trudeau promising to increase border enforcement to try and avoid tariffs. Mexican President Claudia also saying she's confident she can reach a deal with President Trump. Ed Mills of Raymond James joins us now for more. Ed Mills, what does that deal actually look like?
Well, I think, John, it's a question, do we pull forward some of that renegotiation of the USMCA, which is due to be renegotiated in 2026? I think it is clear that there's going to have to be significant increases in border-related items. We see that Donald Trump is going to lead off after he's inaugurated with a number of immigration-related issues. I do think, as it relates to both Canada and Mexico, a lot of changes to the way in which tariffs are done on autos, and probably a huge push towards protecting the U.S. auto industry, especially vis-a-vis China. And I think what it really comes down to, especially as it relates to Mexico, is that U.S. tariff policy, John, states that you put a tariff on where a product is finished. China knows that. China is moving a lot of production into Mexico and then is able to bring things into the United States tariff-free. That's known as the Mexico backdoor. Donald Trump is going to want to make sure that Mexico backdoor is fully closed.
Ed, there is a lot of people that are listening to what you say. They heard from the president in the last week, and they just believe that the tariffs that he's threatening aren't credible threats because he won't follow through on them. Peter Chair of Academy wrote over the weekend, consensus is right now that this is just a bargaining chip. Bring them to the table. They've come to the table and maybe get a little bit of something out from them. They don't think he's going to follow through. Do your clients see it quite the same way, Ed?
John, I think that's probably right. I was kind of going through this yesterday, thinking that when I wrote the note last week about the tweet on the 25% tariffs that could be coming, there wasn't the same market reaction that we saw back 2017 to 2021 during Trump 1.0. I think that there is a long list of tariffs that were proposed against Mexico in particular during his first term that never were followed through. So right now, I think that the market would be surprised to the extent that these go into effect. The thing that I am watching, especially as it relates to Mexico, is that I think there's a personality clash between Donald Trump and Mexican President Claudia Sheinbaum ready to happen. And I think that is probably the wild card to watch. She's going to be much more forceful in protecting Mexico, and Donald Trump is going to be also much more forceful on immigration in his second term than he was in his first term. And as that personality clash pays out, I think there's a higher probability for some of these tariffs to go into place, at least temporarily. He's talked about using some dormant authorities that the president has not been using in the past that can put on temporarily tariffs up to 15% without Congress, without an investigation on day one if he wants to do it.
Ed, can you take that a step further in terms of what we've learned from some of the recent conversations, or at least the readouts and the contradictory readouts from Mexican head Claudia Sheinbaum and Donald Trump, as well as the recent meeting with Canadian Prime Minister Justin Trudeau? How much is this just Donald Trump testing different leaders' abilities and willingness to come kiss the ring versus actual policy prescription at this point before he even enters the White House?
No, Lisa, I think you are right. I do think that this is a testing the waters phase of this. I do think that the readouts have to be taken with a grain of salt. Donald Trump is not using kind of the traditional ways in which we deal with diplomacy, not getting the State Department involved. We all know that. So kind of each president is able to put out their own kind of message as it relates to Donald Trump or Claudia Sheinbaum. Justin Trudeau, as prime minister, is able to put out whatever he thinks that is necessary. But I don't necessarily think that this is something that you test it out, get some changes, declare victory, and move on. The issues that he's talking about, and then you put into place some of the personnel picks. Howard Lutnick at Commerce, going to be very aggressive on tariffs. Jamieson Greer, who is going to be the pick for U.S. trade representative. One of the reasons Donald Trump picked him is he's going to be much more willing to be more aggressive with some of those authorities that I've discussed than Bob Lighthizer. So I understand the reluctance to over-index or over-expect that this is going to happen on day one. But tariffs are coming. It is going to be volatile, and we have to expect the unexpected when we think about Trump 2.0 for this market.
And how many of these nominees are actually going to get through at a time where we have a lot of clashes between already John Thune, who is the head of the Senate leadership for Republicans, and at least one or two of these candidates?
Yeah, so I was looking at the ones that you've put up on your screen. I think most, if not all, of the picks for Treasury Secretary, U.S. Trade Representative, Howard Lutnick, more likely than not to get confirmed. FBI Director, a big question mark. The Defense Secretary, big question mark. Health and Human Services, an area at Raymond James that we've been getting a lot of more of a question mark, but probably in that toss-up category. So Donald Trump with 53 votes in the Senate, and it only takes 50 to get the nominee confirmed. Far more than would normally get confirmed if we had the old 60-vote majority that was required in the Senate get confirmed. Donald Trump will have a cabinet that he wants. There will be some exceptions, but for the most part, I've been telling clients, expect the vast majority of these nominees to be sitting in their post sooner rather than later, Lisa.
Meanwhile, Ed, we do still have a sitting president. He occasionally tries to remind us of that. The latest coming out with some new restrictions on Chinese semiconductors, in particular having to do with AI memory and tools to build the high-end chips. How do you interpret this, basically, some of the actions that we're seeing out of the White House now at a time where a lot of people have almost discounted current President Joe Biden?
So as it relates to tech restrictions, Lisa, I've been telling clients at Raymond James, this is bipartisan. This is something that the Biden administration picked up the torch from Trump 1.0 and accelerated that during his term. We will get these restrictions out during the Biden term, but they probably go even further during the Trump term. The restrictions that we're discussing this morning are restrictions that have been in the hopper for months. The Biden administration has been working with the Netherlands and Japan trying to get a trilateral deal. There are some differences in the way in which the United States, the Dutch, and the Japanese enforce these tech restrictions. That is an unfair issue for U.S. companies. The expansion is about making sure that China doesn't engage in what has been a game of whack-a-mole, where as soon as we put on restrictions, they either move production to a new country or they establish new companies that are not on restricted lists. I am anticipating that the Biden administration tries to tighten up that game of whack-a-mole. The big question to me for clients is, how much of a hammer does Donald Trump come after that next year and tries to end that game of whack-a-mole and has much more restrictive changes to semi-cap equipment going into China, especially on legacy equipment during his second term?
It's a big question for all of us going into 2025. Ed Mills of Raymond James. Ed, thank you, sir. Just check out the picture of Donald Trump, President-elect's economic team. And let's go through the names, and we'll talk about the name that's not there. Hassett at NEC, Jamieson Greer, US Trade Representative, Scott Bessent at Treasury, Howard Lutnick at Commerce. The market was very worried at one point about Ambassador Lighthizer going into the cabinet again, but maybe becoming Treasury Secretary, maybe ending up at NEC. The reporting from Axios over the weekend, almost reinforced by Ed Mills there from Raymond James, that the people that have been selected are going to be even more hawkish than Ambassador Lighthizer would have been. Axios essentially reporting that over the weekend, that Lighthizer wasn't selected because he wasn't going to go big enough on tariffs. I'm not sure what that should tell you about how far they're willing to go.
There have been a number of signs that President-elect Donald Trump isn't happy with the market, viewing some of his tariff threats as simply that and not actually having meat behind them. And it seems like that is going to be a continued theme.
A conversation, and that theme's going to be the theme potentially of 2025. On that, Wendy Stewart at Bank of America. Up next. Equity futures recovering here. We're just about unchanged on the S&P 500, moving into positive territory on the Nasdaq 100, on the Russell after a stellar month of gains for the month of November. The Russell up by close to 11% through last month. The small caps this morning outperforming. We're up 0.25%. With 2 hours until the cash open with some morning movers. Let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. Stellantis, let's kick off there. This is the ADRs. We've done a full vault face from the management at Stellantis. They've gone from unanimous support for Carlos Tavares staying until 2026 to leaving with immediate effect. He is, as Oliver Crook in Germany said, he is the PE master of the auto industry, cutting. But did he have a big enough plan to take this company forward? We know that this is Michigan calling Turin. We have a problem. Rapid degradation of Jeep, Ram, Chrysler and Dodge. Reckless short-term decision making. That was back in the autumn. That was the message from Michigan to Turin. We're here too. And their sales in the United States of America have absolutely drifted down, not crashed. We've gone from the second quarter of about 11.7% market share here, all the way down, John, to just under 10%. So this is a dissipation of positioning. And what do you do to turn it around? Have a look at NVIDIA. I think there's a couple of things going on with NVIDIA this morning, down by 0.4%. More curbs from the Biden administration, but that's not going to really wrought much damage for NVIDIA. Under the hood, Bridgewater sold 1.8 million shares at the end of the third quarter. You never really know the rationale or the reasoning for these moves, but they lumped up on Supermicro. So it's just a little bit of a kicker in the NVIDIA story this morning. Gap. We spent a lot of time talking about the retailers last week. The stock is up just under 5% this morning. On earnings day, it was down 9%. Dana Telsey was sitting with you and she said innovation is the key. Well, JP Morgan sat down with the management, Richard Dickinson, and the CFO, Katrina O'Connell. And they talk about a consistency of the playbook. They have got the recipe right. It's now about execution. Jonathan, good morning.
Manus Cranny, good morning to you, sir. We'll see you again in about 60 minutes' time. I want to turn to France just quickly. Check out the euro, French 10-year, and the French equity market as well. The equity market recovering in the last few moments. The CAC 40 now positive on the session by 0.2%. As session lows, we were down by more than 1 full percentage point. Just some headlines crossing in the last few minutes, Lisa. Maybe some concessions for Marine Le Pen.
It seems as if Marine Le Pen's argument that don't take away the stuff that people really like just in the name of budget fiscal prudence has gained some traction. This saying that basically the government will not drop drug reimbursement in its 2025 budget. Basically, they were going to revoke some of the reimbursements that they give out for drug expenses. They aren't going to do that anymore. Again, this is sort of edifying this feeling that the government will not necessarily disband, that France isn't going to be in a political crisis in the near term as a result of basically kowtowing to some of the demands coming from the far right.
Supporting French assets just for now. We'll keep an eye on that story for you. Under surveillance this morning, a top story over the weekend. Stellantis CEO Carlos Tavares stepping down following a board dispute over weakening sales and a stock slump. Sources telling us here at Bloomberg a new CEO will be named in the first half of 2025. Ollie Crook did a great job of covering this story out of Berlin for us a little bit earlier on this morning. Clearly, the path forward is a troubled one. And right now, there's no one steering the ship.
Real question of what they plan to do to turn things around. Will it be a fire sale of inventories? Had some cold water poured on that from Tom Narayan, and they don't really want to do that if they can help it. There's a real question about a spin-off of potential brands or closure of others. It seems like universally, whether it's dealerships, whether it's actually the workers on the line, everyone seems happy that there's some sort of change based on the commentary. So question now is, how do they turn the ship around at a time that's very difficult for the auto industry?
We spoke to Carlos a number of weeks ago. He was always generous with his time. He really laid out the challenge for European automakers into year end. He wanted ultimately to see a plan from European officials to incentivize the purchase of some of these EVs, which were lagging across the continent, or ultimately we'd have to cut capacity. That's not going to win you any friends with the workforce. Didn't win many friends with the dealerships. We saw those complaints because there weren't enough investment, wasn't enough investment. Their complaints were things like there weren't enough models to sell, new models. There were the problems there. I want to understand where the tension was between John Alcan, the chairman of the company, heir apparent to the Agnelli family over the last few years. The tension between him and Carlos Tavares. What did Carlos want to do that Alcan was upset with?
Did he want to spin something off or close a specific brand? We will be looking for the write-up, the play-by-play about what actually happened over the weekend. In the meantime, a real question of why Carlos Tavares wasn't the fall guy, why he didn't make all of the hard, bad decisions and then leave. I mean, ultimately, there was sort of a question, don't you want a clean house? And if you're already unpopular, well, it's carte blanche to go do all of the unpopular things that people are saying might be necessary to revive the brand.
Still waiting for that kitchen sick moment for the European automakers. Canada says it will step up border enforcement in a, quote, visible and muscular way as it looks to avoid tariffs under a new Trump administration. The Prime Minister Justin Trudeau met with President-elect Donald Trump at Mar-a-Lago on Friday.
What do you think that conversation was like? We're not the problem. Why are you picking on us?
They looked happy around the table.
Yeah.
I've got no idea what the conversation was like behind closed doors. I imagine it was slightly different.
You know, play along, just make me look good. I'll have a win here. Look, ultimately, Canada needs the U.S. just as much as the U.S. needs Canada. And nobody seems to be taking, as you've pointed out many times, some of the threats for tariffs seriously, particularly with Canada and Mexico. If there truly were some sort of massive 25% tariffs, but particularly with Mexico, that would torpedo the entire auto manufacturing industry in the United States. So let's see what actually happens. And it's the reason why people aren't really taking it seriously.
I want to be very clear about what we're saying here. They aren't taking it seriously. We're not making a judgment about whether they should, because that's a very different conversation going into 2025. Maybe they should be taking it seriously.
Especially if the Axios reporting is correct, that Robert Lighthizer wasn't selected not because he would be too extreme on tariffs, but because he wouldn't go far enough. And that's a real question here. How much is this going to be raising the ante, especially if the market doesn't take this more seriously?
The Biden administration is making its own moves, restricting exports to 140 Chinese companies in the latest effort to rattle China's chip industry. Reuters reporting restrictions will also be placed on Huawei's chip-making partner, Semiconductor Manufacturing International. That's another issue this sector's going to have to deal with into 2025. Big issue for commercial banking as well. Wendy Stewart of Bank of America saying next year will be a year of change and uncertainty. Certain sectors and industries will benefit, others may not. I'm pleased to say that Wendy joins us now for more. Wendy, welcome to the programme. I'm just thinking of the long list of things that your clients have to confront in the next 12 months. Taxes, tariffs, the prospect of interest rates not coming down as fast as maybe we thought they would only 2 months ago. What's the number one issue in the conversations you have at the moment, Wendy?
Good morning, Jonathan, and thank you for having me. So, when you think about our clients in global commercial banking at Bank of America, we work with over 15,000 middle market companies that are based in the U.S. and Canada, and they also do business around the world, and we cover their international subsidiaries. And these clients are publicly traded companies. They're also privately held companies, and we're continuing to see the generation transfer from the second to the third and the third to the fourth gen. And so, when you think about all of the things that they're faced, there is a lot of uncertainty as we go into 2025. And you mentioned a lot of the things that are top of mind for them. Increasing considerations around tariffs, taxes, interest rates, inflation, and then also just the geopolitical tensions that we've seen. And, let me give you an example. We have a lot of clients over the last 18 to 24 months that have looked at what is happening geopolitically. They do a lot of business in Asia. And as they've looked at their China Plus One strategy, they have moved some of that business into Asia. And also, they've also moved that into other parts of North America, specifically into Mexico. And you all have been talking a lot about tariffs and what will that mean for clients. And we've got a lot of question around that still. But I can tell you one of the things they're focused on in Mexico right now is the deflationary environment with the peso. And so we've been working with our clients to help them with that. And I do think that while we see a lot of uncertainty, we are looking at how we turn that into opportunity.
Well, Wendy, let's talk about that a little bit more. Are they in a position to play offense, or are you finding them holding back on making big investment decisions, big capex decisions until they've got the clarity on policy into next year?
I would say they're not making big investments, but they are making targeted investments. And so, we have seen a lot of good opportunity for our clients, especially, when you think about investment banking. And these aren't necessarily some of the M&A that would hit, the headlines very broadly, but clients are looking at opportunity to make those targeted investments. And I'll give you an example. We have a client that's based in the southeastern United States, privately held company. And this company did not have an exit strategy. They wanted to take some liquidity off the table, and they were looking at that liquidity event. And so in the meantime, we had another client that is based in Europe. That company did not have any U.S. exposure. And so these two companies, we introduced them, and it was a great fit. It enabled the Southeastern company to have that liquidity event they were looking for while also retaining a minority stake in the company. It then allowed the European-based company to have that U.S. exposure that they wanted, and we were able to leverage our international expertise to help with that specific transaction.
Wendy, this really raises a fascinating question, which is how much are you seeing a rush of foreign companies looking to partner with a U.S. company to get ahead of any potential tariffs or any potential actions from President-elect Donald Trump?
We are seeing that. And, I don't know that I would call it a rush. I think we've had ongoing interest all year. as companies around the world are looking at how they can diversify into the United States. The middle market client base that we cover is very attractive to them, and we are in a great position to help make those introductions and to see, where those fits would make a lot of sense, and we will continue to do that.
Is there a level at which borrowing costs become prohibitive for some of these companies to expand in the U.S., especially if they're smaller? And we're asking this question as small caps outperform at a time that yields are historically relatively high, at least based in the past 10 years. Is that a concern, or is that not even on the table?
It's not on the table. When we were looking at the interest rate environment in the U.S., we were expecting that to continue to come down later this year and into next year. And for companies that are outside of the U.S. and might look at exposure into the U.S., there is the ability to manage that interest rate exposure globally. And, they can certainly take advantage of borrowing in different currencies depending on what their needs are.
Do you get the sense, Wendy, going forward, that there has been certainty for some of these smaller companies in different regions to expand, to hire, to make some of the decisions that we heard were stymied by some of the political uncertainty prior to the election?
Absolutely. When we look at our clients, I would say the sentiment's interesting right now. There is a lot of optimism, and I think there is some pent-up demand. Clients, I think, have been a bit surprised that the economic environment has been more stable than they were expecting. That, combined with interest rates coming down and that demand, is creating opportunity. And we continue to work with our clients not only as they focus on the geopolitical tensions, what that means for them internationally, but also here domestically. And, we are continuing to do a lot with clients with the core banking needs that they have, whether it's loans, deposits, really helping them to manage their cash management process. And, we have a new client that we've started working with that's based in the Midwestern United States. And this company is also doing business in Canada. They have exposure in two geographies outside of North America in two different regions. And when they looked at that entire cash management ecosystem that they had to manage, they were doing it on a very manual basis. They didn't have a lot of visibility. They had FX risk that they wanted to take off the table. And so we helped them with our Cash Pro system to put a solution in place. It is the platform into the bank that is both online and mobile, and it's enabled them to really manage all of this exposure and continuing to grow in a way that is safe, secure, and very efficient.
Wendy, you've given us some really specific examples, and I was just noting down some of the themes: managing the supply chain in Asia, managing the FX exposure, particularly down in Mexico, getting a presence to the United States, working that out too. Wendy, what I hear here is the need to be with a bigger player. And that's what we saw coming out of the regional banking crisis as well. Customers were looking to the Bank of Americas of this world. Wendy, is that still the same now? Have you held on to those clients? Are you seeing more clients come towards you ahead of 25?
We are. And in fact, 2024 has been a great year for us. It's our second strongest year in terms of client acquisition on record. And we expect that to continue into 2025. And it's for all the reasons you've just cited. Our client base is more global now than ever, and they absolutely need a partner who can help them navigate a lot of this uncertainty and turn that into opportunity for them to help them grow.
Wendy, this was brilliant. A belated happy Thanksgiving to you and to your family too. Thanks for being with us. Wendy Stewart there of Bank of America. Really specific. I think really offered a really good look at what's happening now with corporate America. And I would say arguably corporate America and beyond for the whole world over three big issues: supply chains, FX exposure, and you need a presence in America right now. Selling into the United States is not enough. You need to be in the United States.
Which is a reason why those sort of cross-border investments are going so strong. You raised the question, how much does this really advantage some of the larger players to the disadvantage of some of the regionals that haven't yet clawed back? Do they have a permanent structural disadvantage because of some of these types of trends?
Imagine being exposed to the peso after the month we've just had. Some of those moves are vicious.
Problematic, yeah.
Oh, huge problems potentially. That's the latest story on the banking front. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President-elect Trump is bringing someone that he pardoned into his administration. He's nominated Charles Kushner as U.S. ambassador to France, praising him as a tremendous business leader, philanthropist, and deal maker. Kushner is the father of Jared Kushner, Trump's son-in-law and former senior advisor. He served 2 years in prison for filing false tax returns, witness retaliation, and making false statements to the FTC. Volkswagen workers in Germany have begun their temporary walkout, hoping to pressure management during deadlocked negotiations over cost-cutting measures. The union opposes management's plan to close 3 German factories and lay off thousands of workers. A 4th round of negotiations is set to take place 1 week from today on December 9th. And it is Cyber Monday, and consumers are looking for deals online. Adobe Analytics, which tracks online shopping, expects consumers to spend a record $13.2 billion today. That's 6.1% more than last year. That would make it the season's and the year's biggest shopping day for e-commerce. That's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, bot vigilantes thriving in Europe.
The French government doesn't take ultimatums. It's looking at the French parliamentary debate. It's respecting each and every parliamentary debate that leads to an evolution. We will take into account what is changing, but we won't be blackmailed. We are committed to reduce the deficit.
We'll get you the latest on a last-minute concession to Marine Le Pen in just a moment from New York. This is Bloomberg. Stocks are doing okay here, coming off a month of gains that's delivered gains of more than 5% on the S&P and on the Nasdaq. We're just about unchanged on the S&P, so no drama here. Bond yields a little bit higher, off session highs. We're up 3 basis points on a 10-year, 419.75. Under surveillance this morning, bond vigilantes thriving in Europe.
The French government doesn't take ultimatums. It's looking at the French parliamentary debate. It's respecting each and every parliamentary debate that leads to an evolution. We will take into account what is changing, but we won't be blackmailed. We are committed to reduce the deficit. The government is a government of dialogue, of respect, of co-construction. This budget has been co-constructed. It's not the result of just a government project.
So here's the latest. The French government offering a final hour concession to Marine Le Pen's party on the 2025 budget, seeking to avoid being ousted from power in a no-confidence vote. The political uncertainty recently sending French borrowing costs to the highest levels relative to Germany since the Eurozone debt crisis. Joining us now to discuss is Michael Kushma of Morgan Stanley. Michael, good morning to you.
Morning.
Giant step back. Lisa's talked about this for a while, and I think she's right to pick up on it. Bond vigilantes are back, and they're thriving in Europe. We saw it in the UK. We're starting to see it in France as well. Maybe Prime Minister Barnier can hold on. I've got no idea. But to Lisa's point, they're not going to be blackmailed, Lisa, but it sounds like they just were.
100%. Essentially, we're not going to be blackmailed. Yet here you have it, and our deficit's going to be a little bit bigger for a while.
What do you think is behind this more assertive bond market, particularly in Europe?
I think it's the fracturing of political consensus as to what to do with the challenges that are being faced, and putting a burden on fiscal policy when many countries have very little fiscal space to actually deal with this, with increased spending, cutting taxes, things like that. So how do you deal when you're getting pressure from all sorts of directions, and you know one policy mix will fix the problems you're facing?
As an investor, how much does that make you stay away from places like the French bond market, simply because if they do cut their budget, their economy tanks and they have no government? If they don't cut their budget, they have an increasing deficit and with no signs of fixing it. How much do you just stay clear?
I think that's exactly what you do. So I think we've been recommending and following an underweight position relative to French government bonds relative to other countries in Europe. They're being helped by the fact that German bond yields keep going down. So though the spread's widening, absolute borrowing costs are not rising that rapidly. So they haven't risen to the levels we saw in the sovereign crisis back in early part of the last decade, because German bond yields weren't just rising everywhere and causing punitive borrowing costs. Borrowing costs are not really a constraint on French borrowing at the moment, but they could be over time. How is it resolved? Usually it gets worse before it gets better, and forcing actions which are painful to somebody, but actually resolves the problem going forward. Think about today that Greek 10-year bond yields are lower than France, when Greece was completely insolvent 10 years ago.
So this raises a question of, is there a certain profile of countries that are susceptible to bond vigilantes versus not? I think about the likes of France, yes, maybe Greece, although not anymore because evidently they trump France. But in the U.S., it seems like the U.S. is immune to the potential for bond vigilantes, even though the debt to GDP looks like it's on a trajectory that's far worse than any of these countries?
I think it's a couple of things for the U.S. One is the exceptional performance of the U.S. economy and the exceptional position of the U.S. dollar in the sense of a global reserve currency. And President-elect Trump has talked about that important aspect of having the exceptionally strong currency around the world and use of it around the world, which gives the U.S. a special sort of situation. Borrow its own currency and everyone accepts the dollar for global payments. Over time, however, things can get out of control. We saw that in the UK with Liz Truss's government for a little while. But that's farther down the road. And the issues in the U.S. aren't insoluble. They just need to be dealt with. And they can be dealt sooner the better because modest changes can affect the trajectory meaningfully over the next 10, 15 years. So it's more about, I think, the next couple of years. Where is the new administration going to be with regard to containing the growth of the deficit and debt overall? If it's not contained, if it continues to grow bigger, at some point in the next several years, I think there will be a constraint on government policy, which usually creates an adjustment.
Michael, we should perhaps acknowledge there is something somewhat unique about this moment. These issues are arising in Europe outside of recessionary conditions. We saw that in the UK. We're seeing it in France. We're running budget deficits north of 5% in America, with GDP running at very robust levels and unemployment close to 4%. My question really is how these bond markets will behave in economic downturns. In developed markets, they are bought. When things go wrong, you buy those bonds. Are we going to challenge that next time around?
It could be, and how we fixed it last time with quantitative easing, right? When to make sure that monetary policy or deficit problem, inflation problems did not cause problems with long-term interest rates, the central bank stepped in and bought trillions of dollars of government bonds to support the monetary and fiscal policies being used. But down the road, if central banks feel constrained and don't want to do that, then it becomes more problematic.
Does this become problematic for portfolio construction?
It does. Well, inflation has been actually going up a bit in the United States lately in the last couple of months, or core PCE data, which is what the Fed's preferred measure of inflation. That's been going a little bit the wrong way. The unemployment rate has been coming down a little bit the last couple of months from the levels we saw in September, putting a little more pressure on the Fed. Maybe we shouldn't be easing too aggressively going forward, given the situation, which again puts upward pressure on bond yields.
This has got to be the number one question going into a potential economic downturn. Let's assume we get one. Do bonds behave as a ballast in the portfolio next time around?
It depends on what causes the downturn and whether it's stagflationary. But ultimately, it's a great question because if you do not get that kind of haven reinforcement of bonds, that really limits and ties the hand in terms of the fiscal response to any potential downturn. And that is the fear that people have, including the Federal Reserve. Maybe the reason why they are acting a little bit more carefully right now as they try to thread this needle.
Michael, good to see you. Great to catch up. Michael Kushma there of Morgan Stanley. Next up on the programme, Tom Kennedy of JP Morgan, Dana Telsey of the Telsey Advisory Group, Claudia Sahm of New Century Advisors. As we look ahead to Payrolls Friday, we'll also catch up with Tom Tzitzouris of Strategas. The third hour of Bloomberg Surveillance is just around the corner.
At the end of the day, the best fundamentals are still in U.S. large caps.
Everybody's on the same side of the boat, which makes the market vulnerable to volatility.
Everything seems to be going the way you want it to go. But I think there are significant amount of uncertainties.
You're going to get some good results, you're going to get some bad results, and that's going to kind of create volatility in the market.
Once we get a little dose of reality into 2025, I think that's when you want to start to take some risk off.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now with equity futures recovering. We're just about unchanged on the S&P 500. On the Nasdaq, just about in positive territory. And on the Russell, after a rip-roaring rally through the month of November, we add some weight to that as we kick off December trading, up by almost 0.2%. Going into payrolls Friday, the estimate in our survey, 200k. The high is 270 over at Morgan Stanley. The low is 155 over at Citi. That's Andrew Hollenhorst, trying to bounce back from the previous number, which was a terrible 12k.
And we do get jolts tomorrow ahead of that, though that will be muddied by the weather disruptions. You raised the question, John. How high is the bar for the Fed not to cut rates later this month? And how much do we have to see a really rip-roaring number and also an unemployment rate that falls back down and also wages that pick back up in order for them to do that? I think with that light, it is fascinating that Jay Powell suddenly signed up to do a Q&A on Wednesday at a conference because it raises the question, what do they want to be messaging at a time that does seem pretty fraught with accelerating growth at the same time that they seem to be on a somewhat preset rate-cutting path?
We don't assume, we don't speculate. You remember the lines coming out of the news conference?
Yes.
How much speculation will they be doing this month, looking out to next year and beyond?
How much do they try to remove the political tinge to this by just saying that the economy has been performing better than we expected? That, to me, might be more interesting as a way to subtly communicate that they are having a shift in sentiment on the Federal Reserve Board.
So there's a two-part story before we get to the big one on December 18th. Payrolls this Friday, CPI next week. BMO's Ian Lincoln reckons you need a strong report on Friday and a robust CPI number, signalling maybe some sticky inflation to get this Fed to pause on the 18th.
Otherwise, why not just cut rates and signal that they're never going to cut rates again? Because there's essentially a lot of people are getting on board with that, and it leaves them open to a lot of political leeway, because you have to imagine that 2025 will be all about Jay Powell defending the independence of the Federal Reserve at a time where he already has staked out his territory with a very definitive, I will not go.
We might have a shadow Fed chair, mightn't we? Kevin Walsh? Who knows?
Let's see. Let's see how this goes. But all I know is that he was very definitive when asked about it. And that was a response of a lawyer who had prepared his brief.
Agreed.
And is prepared.
That was the standout moment from the news conference about a month ago. Coming up this programme, we'll catch up with Tom Kennedy of JP Morgan as the S&P 500 caps its best month so far this year. We'll speak to Dana Telsey of the Telsey Advisory Group on a record-breaking Black Friday, and Claudia Sahm of New Century Advisors looking ahead to November payrolls. We begin this hour with equity futures just about unchanged, following the best month of the year on the S&P 500. Tom Kennedy of JP Morgan looking ahead to the last Fed meeting of 2024 and writing odds of a pause have grown meaningfully. The labour report on Friday really matters, particularly the wage data. We view risk to the soft landing as balance between recession and inflation re-accelerating. Tom joins us now for more. Tom, good morning.
Good morning.
Two very, very different risks for 2025. What are you telling clients they should do?
I think it's just balancing out their portfolio to make sure you feel comfortable with your strategic asset allocation. Are you aligned there? Do you have big overweights? Are there places we can correct? I think heading into this meeting in December, it's really fun to just play this game that you guys are going through here. First thing they're going to look at, what's the probability the market assigns to a rate cut? 65% as we sit here today, so they're getting good optionality. But the really important thing they're going to do is check in on their SEP from September. Growth number for 2024, 2%, it's too low. Inflation number, 2.6% core PCE, that's too low. And the unemployment rate, they have 4.4 in for 2024. That's probably too high, which is why we come back to this report on Friday, why it really matters. I agree with you guys. Last month for payrolls was an anomaly. We got to make sure we're still on a really good track here, and then the Fed will have optionality. That's really what I expect out of Powell this week. He's going to try to just confirm that he has optionality. That's what data dependence is.
Well, based on what you've just said, I'm not sure what the options are. Because if you go into this meeting and you revise growth higher, revise inflation higher, and revise down unemployment, how on earth are you cutting interest rates?
Yeah, I think it's going to be now about where is this neutral rate estimate that you have. Lori Logan, who's the president of the Dallas Fed, gave a great speech last week. Could have been the week before. Just about the range of...
It's all a blur, Tom, don't worry.
The range of outcomes on neutral and the range of estimates. And we are getting to the top end of that range. Now, I think what Lori was trying to do is to say that we are data dependent. We're going to have to feel our way out here, but we're getting to the top end of the range. And the market really has responded by pricing in more pauses into next year. I think that's the real question that they'll have to come out with. If they do end up cutting, it's just going to be about rates are just restrictive still here, and we can cut and still get that soft landing.
You mentioned the game that we were playing and that we have fun doing it. There's a question about whether it matters even right now, given the fact that it seems like the Fed has kind of taken a back seat to just the actual raw economic data and the headline policy making that seems to be happening. So do you think that it matters? Do you think that ultimately, whether they cut or they don't cut, it's going to make a big difference for a lot of investors?
The way I really think about the does it matter or not is, if the reason they are pausing is that the economy continues to surprise us for the upside, which going back to my notes with you guys for the last 2 years, that's been a theme consistently, the U.S. economy is surprising to the upside. If that's the reason they're not cutting, well, what's the type of equities that I really want to own? And if the event that they're cutting because the world is slowing, do I have the right types of ballast in my portfolio to keep my portfolio as resilient as it can be going into 2025? For our outlook, resiliency is a big piece of this, because when I look at client portfolios, they tend to be still overweight risk and overweight cash, not a very resilient portfolio.
You talk about the two bifurcated risks, one of recession and one of a reacceleration in inflation and growth. Do you have one scenario that seems more likely than the other? And if the Fed were to cut rates in a couple weeks, as most people expect, is that risk of a reacceleration that much greater?
I think the point of saying that they're balanced between these risks is that it's a more normalized environment than what we're willing to appreciate. For the last 15 years, we have had the comfort and resiliency of the Fed forward guidance. And at the moment, we just don't have any forward guidance. So in your portfolio, those balance of risks being relatively equal is to really signal from our perspective to the world that is your portfolio really balanced for the risks in the outlook looking forward. Go ahead.
Well, what is the ballast for a recession?
I still think it's going to be the Treasury market and core bonds. Talking about this in the prior segment.
Yeah.
The real point of it is, where would you go when the economy and revenues for your stock that you own, those revenues are deteriorating? Where are you going to go to hide? What are your real options? I don't really think there is anything else besides the Treasury market at the moment. Is it cash? Or really what we're trying to push our clients into is thinking about alternative ways to find income that are long duration. In our family office survey from this year, 45% of the wealthiest families in the world own alternative assets. Historically, we would say, oh, you can't own alternatives because they're illiquid. Well, 50% of all of our private asset alternative raises this year were in evergreen products. The market is changing. The ability to financialize alternatives allows people to own real estate, infrastructure, different assets for income that don't need to necessarily be tied just to the Treasury market.
Completely depends on what the objectives are, but certainly if you're retiring, you don't need the money for 20 years. You've got to ask yourself why you need the daily liquidity. This is an argument that Apollo has made repeatedly over the last few years. Do you see clients changing their attitudes to alternatives?
Absolutely. I think if you look out 3 years from now, every single one of our clients will have more alternative assets in their portfolio as a percentage than they do today. This financialization helps them, but also in the private space, things are evolving as well. The secondary market is growing. Get more liquidity in your existing private equity alternatives. And then also private credit. How many years now? Private credit's a bubble. It's a key piece of the financialization, and it's adding liquidity to sponsors at a time when they need it, and investors are willing to take the higher return.
Who loses out? And when I say who, I'm thinking about what asset class, what securities would typically attract that money, but won't anymore.
I think it's mostly going to be about how do banks adjust themselves to be a part of the lending solution here. There's concentration happening in the banking sector as well. I don't think it really does crowd out things, John, in the way that you're talking about it, saying money has to come from the public space to go to the private. IPO issuance is non-existent. When are we really going to ask the question of why are we expecting IPO issuance to go back to what it was? I don't think we should. The private business owners don't need to go public anymore. There still needs to be a certain amount of that just for the sponsors and the private equity back, but we don't really think IPO issuance is going to go back to where it was. So just the nature of new assets and new money is going to flow there.
This raises a question, and I just think of Adina Freeman over at the exchange, screaming, throwing things at the screen as she listens to you. And there's been this argument that actually, if you don't have companies going public and putting the disclosures and having the same kind of transparency, that somehow impedes the integrity of the system. Are you saying that that risk has not materialized and won't materialize in a lot of markets that people traditionally have thought of as more obscured?
I think you're going to need to see transparency come to that market. We're already seeing transparency. JP Morgan provides most of the leverage to the private credit space. What does that mean? A sponsor who's giving the loans out takes leverage from a bank. So they're still connected to the banking sector. And that affords transparency for us to see those individual loans. I just think the nature of transparency will change, Lisa.
Is the argument that essentially traditional asset classes, bonds, stocks, aren't going to have the same kind of returns going forward because we brought forward a lot of those returns and because yields are higher?
Not necessarily. I mean, you look back in history when you see big years like the one we just had. Over the last 75 years, if you see a 20% gain in the S&P 500, on average that next year, you're up 10%. And about 80% of the time, you're up the year after. So markets can do well. I'm just saying the nature of where the earnings for these businesses is happening is shifting from public companies to private companies. And this, my clients need to adjust alongside it and invest alongside those earnings. And that nature, I think what I'm trying to draw out here is, when are we going to ask, this is a constant, perpetual change? Reversion to the mean in this sense is unlikely to happen.
You touched on it. Key overweight, big favourite for next year, financials, the banks. And part of it is the IPO story, all of this activity picking up again. Are you questioning that allocation going into next year?
No, I think
you still like the financials.
I think financials look fantastic from a perspective of earnings growth changes happening. That's alongside the soft landing, and you can actually see leverage start to accumulate. It doesn't have to be the IPO market. It can be leverage accumulation or leverage extension elsewhere. Also, the curve should start to normalize here, again incentivizing the lending market to pick back up again. And from a valuation perspective, it looks relatively attractive to other things we have. So financials is a key overweight for us, and then also industrials and utilities. Tech as well, but we're broadening out that tech discussion. It's happening. Last 3 months for sure, arguably somewhere in the 6-month range, you're seeing the broadening out. That's where we expect earnings to accelerate the most in those three or four sectors.
Utilities have been part of that tech discussion for most of this year. Tom, it's good to see you. Appreciate it. The conversation I didn't expect to have about capital allocation and some of these big shifts we're seeing.
But it's actually really relevant at a time where there's been so much money flowing into the United States and U.S. exceptionalism, and people say valuations are high, especially if a lot of these public companies comprise a much smaller portion of the overall investing market than they have traditionally. So it's one that we have to keep going back to, even though it's not exactly in tandem with some of the more visible balls and strikes.
Mark Rowan's been saying it repeatedly to us on this program now for the last few years. Equity futures right now on the S&P just about unchanged. Let's give you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The French government is seeking to avoid being ousted from power in a no-confidence vote. Prime Minister Michel Barnier offered a final hour concession to Marine Le Pen's party on the 2025 budget. His office says that he has committed to not cutting reimbursement for medicines. France's parliament is due to convene at 3 p.m. Paris time. People familiar say De Beers has cut diamond prices by more than 10% across the board. The Anglo-American unit has tried and failed to put a floor under the slumping diamond market. Man-made diamonds and a collapse in China's luxury market have both undermined prices. The price cut is its first since the start of the year and a historically large reduction. The Buffalo Bills are headed to the playoffs after last night's 35-10 win over the San Francisco 49ers. The freezing temperatures and continuous snowfall couldn't stop Bills quarterback Josh Allen with 4 touchdowns, including 1 rushing and 1 receiving. The defending NFC champion 49ers season continued to go downhill last night, with Pro Bowl running back Christian McCaffrey injuring his knee on a non-contact play. Week 13 continues tonight with the Browns and the Broncos on Monday Night Football. That's your brief. John?
Danny, thank you. Those fans dedicated. Did you see the conditions?
Oh, yeah, there was like snowball fighting.
Ridiculous.
Well,
They're like wading through snow to find their seats in the stadium.
It just adds to the extremity.
How doesn't that game get cancelled?
Of course not. It's like ice fishing, except watching football. It's honestly, it's okay. Wonderful.
That's
it's extreme.
Enjoyable.
Well, you then play in the snow. You feel like you're hardcore. You go home, you have war stories to tell your children. I absolutely endorse it.
You get ill, you don't go to work.
Oh, come on, have some fun.
Okay, apparently that's fun. Up next, the Morning Calls plus Dana Telsey of Telsey Advisory Group as retailers see record online Black Friday sales. That conversation is up next. The opening bell 1 hour and 13 minutes away. Equities are doing okay, just turning positive in the last few seconds. Yields are still higher by 3 basis points. The 10-year 4.20. 1.32, and the dollar stronger against everything in G10. The euro down to 105.11. Time now for some morning calls. First up, Stifel raising its price target on Tesla to a street high, noting confidence in its FSD capabilities and Cybercab promise. Your second call from Guggenheim, downgrading Coles to neutral, citing softer sales and a CEO transition. That stock is up by about 0.4%. And finally, JP Morgan upgrading Gap to overweight, saying the company is at an inflection point to support sales growth. That stock up again by 4.8%. Let's stick with retail. Retailers seeing a record-breaking Black Friday. Data from Adobe Analytics showing consumers spent $10.8 billion online as they look for the best possible deals. Dana Telsey of the Telsey Advisory Group writing, the theme of holiday 2024 is one of selectivity, whereby both consumers and retailers are more discerning in allocating dollars. Dana joins us now for more. Dana, good morning.
Good morning.
Busy few days for you. You've been into the store so we don't have to. What's it like?
I think overall, traffic built as you went on through the day on Friday. You don't have the morning rush like you did in the past because the promotions are elongated and you could have gotten the deals even earlier on. But the going rate seems to be 30% off. You could get additions to that as you go through the weekend. And today's Cyber Monday. Expectation is for a 6% increase in online sales on Cyber Monday.
Is it a legit 30% off? Because there is a take at the moment for consumers. I think they've started to believe that maybe these deals aren't really deals and that maybe they're being misled somewhat. Are they real deals?
They're real deals. They're real 30% off. Look at the inventory levels. They're not piled high to the sky like they had been in the past, but you're getting the deals for the event-driven spending that's out there. And retailers know they have to promote to do that. Look at the traffic we saw. We had teams around the country, and basically whether it was Abercrombie & Fitch, Victoria's Secret, Bath & Body Works, Ulta, Sephora, Lululemon, we saw lines. Now, is it all day? It's in the height of the day when you saw that traffic.
Never change, Sean. Are they really deals? How are they just trying to mess us over?
They say it's 30%,
Yes.
but it's 30% off a price they charged for about 5 minutes a year ago.
Right. Well, this is the reason why people are more selective and discerning with their money and then put things in a basket and wait for an additional 10% off. So if you want to do that, the Farrow household is open to you. I am wondering if there are certain types of stores that saw traffic as people became more discerning about the experience, too, that they wanted to be having.
I think you saw the specialty stores, probably Victoria's Secret with the lines that they had, that was compelling. You haven't seen those lines in years past. Bath & Body Works always has a line on Black Friday because of the deals that they do give. And then what you saw at Hollister's level of promotions was 30 off. Last year it was 40 off. We have a tracker that goes back to 2018 showing the differences in the level of promotions. And for the most part, Nike was the one that was a little bit more promotional than it was in the past, which is not totally surprising.
Do retailers like that e-commerce is taking such a big slice of the pie? And I don't mean this in terms of other people's, but I mean even their own. Is it less profitable for them to sell online with all of the returns and the processing and the expectations that come around that?
Overall, you need both. And what you're seeing today is a lot of the stores fulfill a lot of those online orders or the buy online, pick up in store. Overall, online sales are still an important part, but still physical in-store shopping is the greatest part. You're not seeing the big pickups in traffic because people have been shopping all along. But physical retail and the newness of stores that are out there, look at the new Aritzia store that opened in Soho. The traffic was big there on Thanksgiving Day when I was there, and even on the Friday on Black Friday too.
To John's point about, is this really a deal? How much have these stores cannibalized from the excitement around the post-Thanksgiving shopping moment, given the fact that these deals stretch over a longer period of time and feel like an evergreen type of event?
So overall, retailers buy for events. Retailers will buy for promotional time periods. We always know that traditionally after Thanksgiving weekend, you go into a lull until the 10 days before Christmas when a lot of the shopping is done. But you look at this year with 5 fewer days than what you had last year, Black Friday weekend could account for nearly 20% of the holiday season sales for the week of the whole Black Friday week. Because now you have fewer days in order to when we get to December 25th.
Dana, who's winning?
I think overall you have Abercrombie's winning, Hollister's winning. Frankly, Victoria's Secret did well. I think Old Navy is taking share as the weather got colder. people started to buy. Walmart's winning. You look at value, look at the traffic in TJX and TJ Maxx, which has become more gift-oriented.
I'm not going to ask you what the correlation is between temperature and Victoria's Secret, but you've mentioned the company a couple of times. I'm not sure it's the winter weather that's doing that. What if they changed? Why is that company making a comeback?
I think some of the stores are retrofitted. I think some of the product lines are retrofitted. They reintroduced sport. They reintroduced bathing suits. They still have a long way to go. But notice lines there, which was different than we saw last year.
I think that there are a lot of theories out there about why that store has come back.
Yes.
And I think that we can explore them at another time. I do want to just take a bigger question. Of course, you're like, why not explore them right now?
No, I'm genuinely curious now. Now you've mentioned it, you seem to know something I don't.
Yeah, well, they changed the look, right? So it had been going for a very progressive kind of everyone's body is wonderful kind of look. And then they reverted back to, you know, the Victoria's Secret.
Oh, Hot's made a comeback. We're doing this in real time.
Please.
Is that what it is?
Can you explain, Dana?
Basically, you have a new leader who came in. She's going to basically retrofit the brand. She's Hillary Super, knows how to merchandise. Let's watch the next year and see how it progresses.
What has she changed so far?
She just started September 9th. So it's first to come.
So what do you think is bringing the crowd back?
So the categories that are coming back, like the sport category that wasn't there last year at this time.
Oh, so they're challenging who now? They're going after Lulu?
No one's going after Lulu. Lulu's on its own because, frankly, what we saw this weekend, Lulu had the most traffic. If you look in that segment, Alo second, followed by Vuori third.
Let's talk about Vuori, some of the private market challengers. How much of a challenge are they providing to Lulu?
I think overall, when a category gets so popular and the margins are so strong, people come in. But when you look at what makes a leader is driven by the technology innovations that they have. Lulu's going to report their earnings later this week, and it'll be interesting to hear about the newness they're putting in, both in terms of their core men's product and women's product. And don't forget the growth in international.
Vuori versus Lulu. Bramo, you know that story well.
Well, I like Vuori, but I have Lululemon products as well. I just noticed that Lulu actually ended up not having the same quality that they previously did. And so there was a quality shift, but that seems to have revived. And I will just say, Lululemon does report earnings this week, I believe. So we will get an update on
Look
that.
out for that. And if you go into store and wait long enough, someone will come in and clear off the shelf and walk out. That's been the experience. Have they fixed that yet?
I think overall what they fixed in terms of the product, it is more colors are in the product, being in stock on the right goods, and having the right fit. I think Vuori started as a men's brand. It's known as soft casual. They've added women's, and they're still in the growth phase.
Dana, it's good to see you.
Nice to see you too.
Thank you. Thank you for the update. Dana Telsey of Telsey Advisory Group on US retailers.
Okay. There was a whole discussion around Victoria's Secret where they were going to get rid of angels and do what women want, not necessarily the Victoria's Secret angels. And I believe that the angels have made a comeback. So it sort of has evolved.
It starts there.
It starts there. And I think that that's part of what's behind some of the shifts there.
It's become more aspirational again?
I mean, I guess so. Yeah, it's become more of a vision of lingerie.
Okay, interesting.
We did this really well. This is great.
Let's wait for next year and see what they have, because then Hillary will have made an impact.
Okay.
Up next on the programme, not that. Claudia Sahm of New Century Advisors and Tom Tzitzouris of Strategas from New York City. This is Bloomberg. Equity futures here positive across the board on the S&P, on the Nasdaq, on the Russell. The small caps outperforming once again, up by more than 0.25%. With 60 minutes until the cash open, let's get you an update on your morning movers. Here's Manus Kranich. Morning, Manus.
Jonathan, a very good morning to you. So the headline on Stellantis is that Carlos Tavares, the efficiency czar, is to go. But it's the vault face that really grabs me, which is it goes from unanimous support for him to stay until 2026 to this to leave with immediate effect. This is essentially questioning the capacity of the efficiency czar to take the company forward and the direction they want to go in. Turin, we have a problem. That was the message from Michigan. He won't be missed here in the United States of America, where you've got Jeep, Ram, Chrysler, and Dodge. The U.S. dealer said it was reckless short-term decision-making that they opposed. Cities say you've got a dissipation of market share here in the United States of America. This is less about the problem with China. Just look at what they had. They had a market share of just under 12% in the second quarter of 2022. That is dissipated to just under 8%. This is not a China problem. This is a USA problem with sales. Roll it over and have a look at NVIDIA. It's a hard call here, down 0.25%. But what is the headwind, or what is the opportunity from the new set of regulation that the Biden administration has lobbied and leveled on top of the chip industry? 140 new companies will be restricted in terms of what they can sell. But Bridgewater sold 1.8 million shares at the end of the third quarter, and they lumped up and bought Supermicro. So a little bit of a backstep for NVIDIA this Monday morning. You've just finished a conversation about retail, but it's worth pointing out that for Gap, you've got JP Morgan upgrading the stock to overweight from neutral. They put a price tag of $30 on this, so there's about 23% left in the upside. Why? They had a meeting with the CFO and the CEO. They believe the story. They believe in the reincarnation. They believe in the marketing story that has been delivered. The line is a consistent playbook of improved merchandising, marketing across all four brands. And just to let you know, I got the full 30% off, and I feel I really did accomplish a bargain in Black Friday.
Good work, Manus Cranny. We're proud of you. Thank you, Manus. Thank you very much. Manus Cranny on some of the movers. Here's another one. Breaking news. Intel. The stock so far this year down by more than 50%. This headline will not be a surprise. Intel announcing the retirement of the CEO, Pat Gelsinger. The board has formed a search committee for his successor.
Yeah, this comes at a time where other chip manufacturers have done very well. And as you mentioned, the share's down 51% so far this year. He will also be stepping down from his position on the board. The foundry leadership is going to remain unchanged. Basically, the only thing that changes is that Pat Gelsinger will not be there. And you've made the point, John, that how do you feel as a leader when you step down and the shares go up? And that seems to be where things are, at least in the initial reading.
We say this all the time. You can learn something from the data and how the market responds to that data. The market's responding favourably to his exit. The stock is up by 3%. The hard work that's got to be done here, though, how offside this company is relative to where it needs to be for the market right now. Obviously, the winner at the moment is the likes of NVIDIA. What does this company need to do in the coming years, and I would say the coming decades, to improve things? This is a big turnaround effort.
Yeah, especially because their hands are somewhat tied due to the grants that they've gotten from the government in terms of how it's going to be deployed when they get that money. There are a lot of questions about how quickly you can turn around a ship in a fast-moving industry where there is a clear leader and they are gaining ground. Also, if Intel is going to be the national champion in the United States, how do they beef up their production in the U.S. when there isn't necessarily the expertise in a mass group of people who could actually make the products the same way that there is in, say, Taiwan?
We will, of course, have more updates for you through this morning. Just to go back over that breaking news from moments ago, Intel announcing the retirement of its CEO, Pat Gelsinger, the board conducting a search for a new CEO. Their stock is up in the pre-market by close to 5% now. Let's turn to the Federal Reserve. The next decision 2 weeks from Wednesday. After payrolls and CPI, Claudia Sahm of New Century Advisors weighing in on the Fed's future. Writing for both the Fed and other policymakers, now is not the time for complacency. Watch the labour market and the rate of business formation. If they slip back and become less dynamic, then productivity and supply-driven growth could slip away too. The US economy has come too far in the last few years to allow that to happen. I'm pleased to say that Claudia Sahm is back with us now for more. Claudia, welcome to the programme. I think we should start there, the supply side of the economy and how much of the hard work that's been doing so far over the course of 2024 and where it leaves the Federal Reserve as it thinks about 2025 and beyond.
Right. Well, it is so important that we don't just look at a GDP number and say, oh, it's almost 3%. And move along. We need to stop and think, what is going on? Why is growth so good? Are we overheating? If we're overheating, then the Fed steps in, they raise rates, they cool things down. That is not what's happening. We have seen a real pickup in growth. Remember, we were promised a recession and we got an acceleration. And we've seen for 2 years running now almost 3% growth. And a lot of that, if you look under the hood, is coming from productivity. And that is the holy grail of economic prosperity. And we should be spending a lot of time trying to figure out exactly how did we get to this place that we've seen a pickup in growth. And this is something the U.S. is seeing and our peer countries are not. So it's a really important question to dig into.
Claudia, given that people believe, and yourself as one of them, that this is becoming a productivity story, does this mean that from your perspective, it's not inflationary, that it doesn't necessarily preclude the Federal Reserve from cutting in a couple weeks' time?
Right. Inflation happens when demand is outstripping supply. That's the 101. There's more to it. But in general, if we have too much demand and not enough supply, then we're going to get price increases to kind of, make the market work.
But if we can get more supply in there, and that is the lesson. We did not get the big disinflation without a recession, without this supply side help. And we got it not just from supply chains, we got it from workers coming online. And we also got this kick of getting people in more productive positions, getting more capital in their hands to do their jobs. And like that was such the way to solve the problem of the high inflation. Well, that's not the only problem that a good supply side solves. It also can really help us thinking about growth over the long term. But we got to get out of our head that it's like all growth and the Fed does interest rates. Like productivity is a really tough nut to crack, and it actually is not primarily about the Federal Reserve.
Claudia, how does Fed Chair Jay Powell message this at a time when he is going to be speaking on Wednesday at a moderated conversation ahead of a time where inevitably, as we've been hearing from a host of analysts, the Fed is likely to revise a lot of its projections with inflation going up, with unemployment going down, and with growth also going up, given the fact that you have seen those upside surprises to growth?
Powell has made a real effort on this, and I would just kind of tell him to, double down on it. He said multiple times the Fed doesn't have a growth mandate, but that's a kind of a wishy-washy way of saying that sometimes when growth is high, the Fed needs to step in, and sometimes when growth is high, the Fed needs to get out of the way. And this is one of those times where the Fed needs to get out of the way because there's productivity there, and high interest rates being unnecessarily restrictive on the economy relative to the dual mandate. It has costs. This high growth is not guaranteed. Unfortunately, that is the thing about productivity that we have learned from the past is, yes, sometimes we get it and holding on to it is what is really hard. So we should not be taking this lightly, that we've got this kind of growth pickup, this productivity renaissance. The question should be, what can all policymakers, and frankly, a lot of these levers are not with the Fed, they're with fiscal or other government authorities, but what levers can we pull to keep this going? And Powell continuing to go back to his dual mandate of the price stability and the labor market, the maximum employment, I think is important because the more we've dug into and researched with this productivity boom, it goes back to the labor market. The dynamic labor market is very much tied back to the dynamic economy, the higher productivity.
Well, let's talk about the labour force growth that we've seen, Claudia. And I wonder from your perspective whether you think it's distorted the Fed's understanding of the influence that they actually have over inflation.
I think the Fed has been very humble and open to the fact that there's a lot that's going on with inflation that we don't understand. And I think they have been probably clearer than a lot of the people watching the Fed that their tools have been they're limited, right? There's a lot of dynamics of inflation that have had to do with supply side that are not primarily about the Fed. The Fed does have a mandate with inflation. They have stepped in. They do need to pay attention. And when we see inflation picking up, they would step back in. So it's not that the Fed is out of the picture with inflation. I think they have tried hard to make it a more nuanced conversation. Nuance is tough, right? But they can't give up on this. And I think this balancing the two sides of the mandate and just saying, hey, this is not about growth. High growth does not mean we need to hike. High growth does not mean that we have no reason to cut. It's our dual mandate. And the growth conversation is a separate piece of this. And if we have to look under the hood.
We enjoyed this conversation. It's good to see you. As always, Claudia Sahm there of New Century Advisors. Claudia, thank you. Of course, Claudia mentioned we will hear from Chairman Powell later this week. We will get payrolls on Friday as well. So two events you need to look for. Next week, we'll get CPI. The week after that, a Federal Reserve decision. Mike McKee joins us around the table with more. Good morning, Mike.
Good morning. And we just got, while you guys were talking, 2 more speeches added to the Fed calendar this week. Tom Barkin of Richmond is going to be speaking on Wednesday and Thursday. So overall, we have a significant number of members of the Open Market Committee who are going to give us their thoughts. The only one that's really going to matter is Jay Powell, of course, as always. Where he is where the markets anticipate that the Fed will end up. And the real question is, what is he going to be able to say about where the Fed ends up, given that jobs isn't until Friday and CPI isn't until next week?
They all matter. I enjoy every single speech. I just want to say thank you for adding to them.
This doesn't sound sincere at all.
I actually think it's fascinating. And I think it's fascinating that they're being added now. Because, yes, it's before the quiet period, but also it's at a time where there's a real question about, A, the Fed's independence, and B, how they're going to address some policy changes that are going to come down the pike that potentially could have a pretty significant impact on the economic outlook. How much is this trying to get ahead of that, to sort of come out there with terse answers to some of the questions, with Jay Powell saying, I will not go if I am asked?
Well, given the way they schedule, I don't think most of this is based on that. Some of it is an opportunity, shall we say, to talk about that. But when you look at what they've said about Fed independence, it's basically the same couple of sentences from every one of them, that it's important because it gives the Fed credibility, and you take that away and then the markets have a problem. They don't really go beyond that, and they don't want to talk about the guy who's going to be president. We shall not mention his name if we're on the Fed. The framework is now going to start being part of what they talk about. And Chris Waller's speaking today on that. There was an interesting Bill Dudley column you've talked about earlier that said the Fed has some work to do there. And so we'll see how far these people want to go in sort of front running that. But the rest of it is going to be just kind of talking to their constituencies, especially the Fed bank presidents who are out talking to Rotary clubs and people like that, universities in their districts.
Tons of Fed speak coming up this week. Mike McKee on some of that Fed speak for you. Going into it, bond yields are higher across the curve, up now by close to 7 basis points on a 2-year. On a 10-year, up by 6. So just pushing higher after dropping through last week. With us around the table is Tom Tzitzouris of Strategas. Tom, good morning. It's good to see you.
Hey, good morning.
In the past, you've talked about this marriage between full employment and declining inflation. I think you said the honeymoon was going to come to an end. Has it come to an end already?
I think so. I think we're going to see inflation trickle a little bit lower from here. But I think for the most part in 2025, we're going to see it moving sideways. Let's say somewhere around 2.25% to 2.5%, both core and headline CPI both converge around there. So a little bit lower. But I think that by the middle of next year, we're starting to see the second wave of inflation beginning to emerge.
Where is it coming from? Is it coming from policies or just naturally already existing inflation?
Well, history says, and we've looked at this data over 200 years of developed economies, about 85% of the time you get a second wave of inflation because the first wave is caused by something structurally changing, and it is amplified by fiscal and monetary policy. But the initial change is a structural shift in the economy. And I think the structural shift in the U.S. economy was the labor market became exceptionally rigid. COVID accelerated this. But the labor market became exceptionally rigid as we transitioned from the baby boomers retiring and leaving with the skills employers demanded to having the Gen Zs and millennials not necessarily having those skills just yet and being geographically rigid about where they wanted to work as well.
When you start talking about potential policies to come down the pike, how much is it really immigration and potential clampdowns on that could be more inflationary than, say, some of the tariffs?
Yeah, I think we've looked at this as well. In tariffs, what we found was, and we don't take credit for this work, but we're kind of quoting work that we've seen, but tariffs would add perhaps between 0 to 1% to CPI over the next 10 years. It's a pretty negligible amount. It could be worse if there's essentially a retaliation tariffs, but it's not a huge impact. The deportation of labor has a much more substantial impact over 10 years, upwards of about 10% impact on CPI total. But the catch with that is there's a lot more uncertainty. And the reason for that is because you have to estimate what is the household formation rate of these households going to be, childbirths, their demand for housing, and what impact will that have on consumer goods and consumer prices. We don't know that answer yet.
Let's talk about immediate policy decisions. About 2 weeks away, Federal Reserve. Are they hitting pause in December?
If they want to maintain this perception that they're independent, I say no. And let me speak to that. The Fed, in my opinion, has pigeonholed itself and has telegraphed too much easing for the next 12 months and an end to balance sheet reduction. If they pivot away from that, it's going to optically look politically motivated. I think they're stuck. Now, the data coming out Friday could make the case, if it comes in strong, that they don't have to go in December. But any sort of hawkish talk is going to look very suspicious.
What's the difference between being politically motivated and being policy motivated?
Well, I guess the way I'd say it is they made quite a bit of effort in the last 12 months to communicate, particularly an end to balance sheet reduction. Those types of efforts, for example, putting out a new piece, a metric on their website talking about reserves in the system. This is their way of telegraphing that they desperately want to end balance sheet reduction. Even if the data changes, then they shouldn't have telegraphed that desire to end balance sheet reduction. 12 months ago, we were talking about Dallas Fed president speaking about the need to almost immediately end balance sheet reduction. They really kind of got ahead of themselves with that. So if they change course now, despite the fact that the data has improved since January, February, it's going to look suspicious. The market is going to see that as politically motivated.
So if they cut, how much do you not like the long end of the yield curve?
Well, for now, we actually like it because we see the next 3 to 4 months a liquidity bonanza coming in. We see upwards of 75 basis points of cuts coming between now and June. It's not a huge amount, and that's roughly what's priced in. We see a debt ceiling standoff taking place from December 31st, at least out to the middle of the first quarter, because despite the unified government, Republicans in the Senate are going to hold Donald Trump's feet to the fire on the budget for 2026 and going forward. So there's going to be a debt ceiling standoff. And we have this unintended consequence when we have a debt ceiling standoff where liquidity comes out of the Treasury's general account and goes into bank reserves. That actually flattens the Treasury curve. On top of that, the deficit should be substantially smaller next year. So for the first half of next year, we could actually be looking at a shortage of treasuries temporarily until we raise the debt ceiling. So we're actually bullish on duration until we get through that debt ceiling raise. When we get through that debt ceiling raise, it's off to the races again. Bond vigilantes are going to find that there's a new appetite to come in and put shorts on.
And then all bets are off. Tom, it's good to see you. Tom Tzitzouris of Strategas, his view on the next 12 months. Some breaking news for you in the last 15 minutes if you are just joining us. That breaking news comes from Intel. Intel is up in a pre-market by about 4%. On that news and some stories elsewhere, let's cross over to Danny Berger. Hey, Danny.
Hey, John. We begin with that breaking news. Shares up 4% for Intel. The company announcing the retirement of CEO Pat Gelsinger. After a 40-year career with the chip maker, Gelsinger also retired from the board of directors effective yesterday. The board has formed a search committee for a successor. Shares of Intel are down more than 50% so far this year. People familiar tell us that BlackRock is nearing a deal to buy private credit manager HBS Investment Partners. The agreement could be announced as early as this week, valuing HBS at more than $12 billion. The deal would give BlackRock, which manages $11.5 trillion, more than $50 billion of alternative assets. And it was a record-breaking weekend at the movies. AMC Theaters said more than 8.8 million went to the movies between Wednesday and Sunday. It was the company's biggest 5-day Thanksgiving period in its 104-year history. Disney was also a big winner. Moana 2 broke the record for highest-grossing Thanksgiving weekend with $221 million in ticket sales in the U.S. and Canada. And that's your brief. John.
Danny, thank you. We'll pick up on that Intel story in just a moment and catch up with Mandeep Singh of Bloomberg Intelligence on the other side of this commercial break, as well as setting you up for the week ahead as we count you down to Payrolls Friday from New York. This is Bloomberg. The opening bout 39 minutes away. Equities just about unchanged on the S&P 500. Your week ahead looks like this. Today we'll get ISM Manufacturing plus S&P Global Manufacturing PMI. On Tuesday, JOLTS. Wednesday, remarks from Fed Chair Jay Powell plus ADP private payrolls and the Fed's beige book at 2 p.m. Eastern. On Thursday, the trade balance plus another round of jobless claims. On Friday, UMich sentiment and, of course, the big one, Payrolls Friday, the November payrolls report coming a little bit later this week. Got to get back to that breaking news. Intel announcing its CEO, Pat Gelsinger, is retiring effective immediately. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, the stock is higher by 4%. On the session, it's lower by more than 50%. Big step back. The problems for this industry right now, the winners seem to be specializing in one thing. Mm-hmm. Either you design the chips or you make them. The people who are struggling, the Intels of this world, are trying to do everything. Why is that turning out to be so difficult?
I mean, Intel as an entity was too big to turn around to begin with. And we have a history of, tech turnarounds are far and few when you think about, Microsoft being the most successful turnaround. And the reason why they were so successful is because they anchored on one thing, cloud. I mean, they even gave up on the operating system. They didn't really invest on the operating system that much. In the case of Intel, the foundry turnaround was the hard part. I think the Achilles heel for Pat Gelsinger was he kept throwing money on foundry when TSMC was way ahead in terms of, that aggressive strategy around 5 nodes in 4 years. I mean, that was so unrealistic to begin with. So that's where focusing on the design side, I think, would have been the right approach. And we have a precedent, AMD being so successful because they spun off Global Foundries, the foundry side. And then look at how far they have come when it comes to the design side.
How much are Intel's hands tied, for regardless of who comes in, because of the government contracts, specifically tied to the presence as a foundry?
So I think the foundry side for Intel, look, they have been the recipient of the CHIPS Act. They have been getting money from the government in terms of turning that around. And in the case of Intel, they have an install base for x86, which is really the core architecture that's still being run on PCs. On the data center side, obviously, they have lost a lot of share to NVIDIA. But I think the government is in favor of local manufacturing, and that is supportive of Intel as a company, for sure.
I guess the larger question is, what should they be focusing on and what should they get rid of?
See, the problem is the foundry side is a very low margin business. Because it requires such heavy upfront capex, you're never going to get to that mid 70% gross margin like a TSMC for at least the next 5 to 7 years. On the design side, they do have a PC refresh cycle that's coming up. And if this AI wave is really secular, 10, 15 years, then people will upgrade PCs. And that's where Intel is still the dominant architecture. There is no NVIDIA. They are losing some share to AMD, but for the most part, it's still Intel. And that's where they can generate a ton of free cash flow. So I would say anybody stepping in now and coming in from outside or inside, I can't really guess, would be focusing more on that PC client-side opportunity.
So, Mandeep, big changes, big challenges for them. What's the first thing they need to do?
Make a strategic decision. They actually tried to acquire Power Semis, which is another foundry company. That never went through because of regulatory hurdles. So clear on strategy. They have 3 rounds of layoffs. Nobody does that. If you're trying to turn around, you cut deep enough once. You don't try to do 3 rounds of layoffs. So I think setting that strategy would be paramount.
They're searching for a successor. Does it need to come outside of the company, given some of the things you've just said?
I mean, if it's from the design side, they should better get someone from NVIDIA, right? So, or if they're doubling down on foundry, then get somebody from TSMC. Those are the 2 clear leaders. So I think it makes sense to get somebody from one of those 2 companies.
Mandeep, it's good to see you. Appreciate it. Mandeep Singh there of Bloomberg Intelligence on the latest news from Intel. That stock is higher by a little more than 4%. No doubt Matt, Katie and Shanali will be picking up with this story in their A block in about 5 minutes' time, Bramo. That's the stock to watch into the opening bell.
You asked the question, does it have to come from outside the company? The new co-CEOs, at least temporarily, are David Zinsser and Michelle Holthaus. Zinsser was formerly the CEO of Micron, so it gives you some sort of sense of where the minds are at.
Coming up tomorrow on the programme, we'll continue the conversation with Ken Tropin of Graham Capital Management, Libby Cantrell of PIMCO, Tony Rodriguez of Nuveen and David Rogel of BlackRock. From New York City, thank you for choosing Bloomberg TV. Welcome back to work for many of you. This was Bloomberg Surveillance.